you for being here. We are delighted to have you. For those of you who don't know me, and I suspect that's most of you in the room, I'm Jim Musser. I am the Director of Economic Education at the Mercatus Center at George Mason University. I suspect most of you know a fair amount about the Mercatus Center at George Mason University, but for those of you who do not, we are a research and outreach center based at George Mason University's Arlington campus. We are not all things to all people. We are economics. We believe that economics and an economic way of thinking help to improve public policy. And to that end, we try to present conferences and educational programming like the one that you have today. I'll also ask that you forgive me a little bit. I have a cold, and I know I'm a little bit croaky and probably don't have the best voice in the world this morning, so I'll ask your indulgence as we go forward. At the Mercatus Center, we're interested in proof. We think that it's very important not just to have the presumption, but to take the presumption all the way through to proof. Whether it's law or economics or pudding making, the proof is in the outcome. Did we really do what we set out to do? Were the presumptions correct? Regulations can start with a presumption, but the proof is really found in whether the regulations successfully address the problem or not. And to that end, we want to dedicate our program today, and we'd like to start with a very special guest, Scott O'Malia, who is Commissioner with the Commodity Futures Trading Commission, is with us today. And in his role, he often sees the need for better analysis to make sure that regulations are effectively addressing the problems that we face with a minimum of economic impact. Scott was confirmed by the U.S. Senate in 2009 to the Commission and will serve a term that runs through 2015. And he brings an interesting blend of skills to the table. He knows quite a bit about commodities futures and commodity prices because he grew up on a family farm. But that's not the only part of Scott's background that really lends itself nicely to his current role. He also has a real background in energy markets. Before starting his term at the CFTC, Mr. O'Malia served as staff director to the U.S. Senate Appropriations Subcommittee on Energy and Water, and he also served as the senior policy advisor on oil, coal, and gas issues to Chairman Pete Domenici of the Senate Energy and Natural Resources Committee. And as a Kentuckian, I am particularly pleased that he also served as a senior legislative assistant to Senator Mitch McConnell of Kentucky. And so without further ado, we'll turn it over to Scott. He will have time for just really a couple of questions at the end. He's got to catch a plane, so we won't hold him up too long, but he's very generously said he'll take a question or two at the very end. So Scott O'Malia.
Well, thank you for that fine introduction, Jim. I appreciate that. I'd also like to thank Robin Bowen, another Kentucky McConnell alum at Mercatus, and appreciate her work on setting this up and inviting me. This is quite a microphone. Well, I'm the government regulator that doesn't believe the government has all the answers. I've come into this job with private sector experience, worked on a little family farm, as Jim said, and want to make sure that the government rules that we put in place today are really the best rules. My mandate, as you've heard, is as a government regulator, is to implement the law. And I've had experience writing the law while working on the Hill, and that's a completely different experience. And I have a very healthy respect and appreciation for all of the federal regulators that have a very difficult job to do. Despite our best intentions on Capitol Hill, we did not have all the wisdom, and we would frequently punt a tough issue or a controversial issue and say, well, let the regulators figure it out. They can put it in their rule. The shoe is on the other foot now, and working for the Commodity Futures Trading Commission, we are in the crosshairs in terms of implementing the Dodd-Frank legislation. We only have Title VII to really worry about. It's a multi-hundred-page document, I think 15 titles in all, but we have Title VII. And we have put forward approximately 50 or 60 draft rules, and we've implemented 39 final rules, all within the period of 2 years. This is a monumental effort for the Commission. To say that we got it right, can't do that. We've struggled at times, and one of the areas where I think we've really struggled is really in some of the fundamentals. Things that are important to the market to implement these rules. The market needs some direction. And we're implementing it. 39 rules. We are comprehensively taking, what was it, the swaps market, the over-the-counter market, roughly $600 trillion notional value globally, 300 notionally here. And you compare that to a $35 trillion futures market that we know and touch and feel and see every day in the pits in Chicago and on the screens, et cetera. So we're taking a massive new market and trying to bring it into what looks to be a very futures-like construct. And I'll go into this a little bit further. The futurization of the swaps market, is it a good outcome? And, you know, we're bound by what we know, and we know futures. So it's not a surprise that a lot of the rules that we've been implementing have turned into very future-like rules, even though we're dealing with a massively different market. Huge notional values that does not trade frequently, but is a completely different beast. So I want to go through a couple of areas and give you some examples. This, for academics, for Mercatus, this is an ideal research event that we are conducting right now. This will provide you hours and hours, years and years worth of academic research and papers you can write to evaluate, did they get it right? And you will certainly not be nodding your head yes. You will say maybe and probably not in most cases. So let me go through 3 areas where I think the proof is now coming in, the proof that you all are looking for and you're trying to validate, and it's having a real impact on the market. Some of you, and let me give you a couple of smaller little anecdotes. We've been sued 3 times already. We've had these rules in place, less than 6 months. Some of them have not been in place at all. We've been sued 3 times. The district court judge just down the street here did throw out our position limits rule. That is going to be appealed. That we have the votes to do that. It's incidentally, and let me just go back. The commission's a 5-member commission, 3 party of the president, 2 minority party. Believe it or not, I'm in the minority party. So we've had a couple of struggles. 1, sued 3 times, lost 1. I've advocated for a rule schedule and implementation plan. Let's let the market know where we are going and how they're going to get there. We have not been transparent at all, despite the president's commitment to be the most transparent administration in history. We are not doing it. And I think where we've fundamentally failed is in the cost-benefit analysis. Now, credit to our general counsel and lawyers. They have told us that we have a very flexible cost-benefit analysis requirement, or a very low standard. And when you have a low standard, to go below that is not a badge of honor, but we've done it, and I think it really needs to come back to Congress. Congress really needs to hold us accountable for doing a good cost-benefit analysis and requiring us to make sure we understand the impacts of our rules going forward. Now, let me, my thesis here is we can do a better job at good government, and there's a lot more that we can do. So, Mr. O'Malley, please explain yourself. What is good government, and how would you know it if you saw it? So, good government, in my opinion, is striking the right balance in order to develop beneficial rules of the road and to implement them according to a measured and reasonable timeline. This requires fact-based analysis in order to come up with the cost-effective solutions based on a range of policy options. Now, I think this is where we've really fundamentally dropped the ball on the cost-benefit analysis. Our cost-benefit analysis is weak to non-existent in some cases, and our lack of policy options presented in each of our draft rules has not been there. And, not my first rodeo. I've seen plenty of proposed rules come out where they would give you a range of options. We are not doing that with cost-benefit analysis prepared by the Commission. Now, in drafting rules, good government means reading the statute faithfully, and and I'll go through a couple of examples here where we have not done that. And then proceeding only when the rule it is clearly based on a firm statutory authority. For draft rules, it means understanding and addressing the concerns of market participants and adopting rules that are clear, that are consistent, and create a level playing field. This past Friday, we were sued on who reports what data to which swap data repository. The only reason we were sued is because two different rules have two different requirements. And so we have a kind of a, Ali Frazier battle brewing here between two entities that want to be the essentially sole repository of data, and they don't want to share it with one another. Monopolies are fundamentally bad, in my opinion, so hopefully we will make sure that this is a good competitive environment, that we're able to share the data widely. And for final rules in this good government solution, it means providing transparent implementation guidance, and it is consistent with our federal rules, final rules, excuse me. One area we're having a hard time, back on the swap data repository, let me give you an example. We've had rules out for over 8 months. We've only licensed 2. There are at least 3 more that have expressed interest in being licensed, but are now wavering because the licensing process is taking so long and is so uncertain. I've pressed our teams to put forward guidance so everybody understands what it is that they need to do to comply with the rules to get a license. It shouldn't take 8 months for 2 entities for swap data repositories. These are fundamentally a mainframe that stores all the trade data and provides it out, that takes it in from traders and provides it out to the market. This is not complicated, yet it's taken us 8 months and only we've done 2. And then finally, I think we need to be aware of the consequences we have, that our rules are having on the market, and have the courage to reassess and revise our regulations where appropriate. Now let me give you some of our rules that we've had a real impact, that have already had a real impact that we've seen so far. The first one is the futurization of swaps. Now, on October 12th of this year, our rules fundamentally came into play. They were now effective. You know who the swap dealers were and where everybody had responsibilities in this new statute and regulations, and what products were going to be regulated. So the who and the what we knew, and we were working on timelines. So on October 12th, the market was going to have to begin to count who is a swap dealer, and we provided a vague definition as to who a swap dealer was, and we basically said anybody below $8 billion didn't have to worry about it, but we didn't tell you what adds to $8 billion as a de minimis threshold. So people were very confused by this, and mainly it was the energy markets, and they said, well, we're not swap dealers. We buy and sell energy as part in the course of our business. That's our regular business. And we also hedge our risk and provide markets because we know something about them as kind of ancillary to our business, but our job is not to serve as a swap dealer. So when October 12th comes in, this is when the rules become effective, just a month ago, people were trying to figure out, well, how are we going to trade these? How are we going to be trading swaps, or maybe we should trade futures? Well, they went back and said, well, what do we know about the swaps market? Well, we know that there's a threat of becoming an overly regulated swap dealer, which we don't want to do. We don't know what the trading platforms are going to look like, and these are the swap execution facilities, which I'll get into in a minute. And we fundamentally don't know who else is going to be in the market with us, and which products are going to be required to be traded versus offered over the counter. So they went back to their exchanges and said, we fundamentally don't want to be in that market. It's too vague and it's too uncertain. We would rather take the risk in moving towards a more standardized futures market where we cannot take, where doing large size of products is probably going to be a challenge. And we can't customize it as much as we used to do in the swaps market bilaterally. But we know more about those rules than we know in your current swap rules. So we would rather take our chances. And I think capital has a big impact in their decision. They don't want 2 pots of margin money out there. They want to consolidate. You want the benefits of netting innovation and being able to net out products so your risk is netted out. Your risk is lowered against the longs and the shorts you have in the market. And it's also much more capital efficient, because the rules we haven't done so far are our margin and capital rules. People don't even know how much the price of this party is going to cost them. So they're trying to figure out all of these things and to figure out what are they going to do with this, and how are they going to trade the products that Congress said you should trade as end users. You should continue, and the commission should do no harm. We've done anything but harm them. We've really transformed their market into a market they really don't see anymore, and they're not comfortable with. So rules became effective October 12th. That was a Friday. And on October 15th, they all showed up and they traded the same products, but they called them a future. And so now they're abiding by all the futures rules, and they absolutely fled the swaps market. There is no liquidity in the OTC space in energy products today. So there is one example of where we are, the regulatory uncertainty, the cost of capital, unclear regulation and implementation plan. Now that is people say, well, Scott, what do you think about that? Futures, swaps, what does it really matter? I'm not sure it does matter. It does change the way they have to trade, however, and it does change the way they have to manage risk. And time will tell what impact this has on their overall hedging strategies. And maybe they use futures predominantly and then go into the OTC space or the swaps market and just manage that basis risk or some of the uncertainty, filling out the curve if they've got any extra exposure there. It's too early to tell, but it was a landmark shift over from swaps to the futures market, literally overnight. Now, let me give you an example. That's not all bad news, but let me give you an example where we have not officially screwed it up, but we are about to. But we can stop it, and that's the good news. So the Dodd-Frank Act tells us that we can apply our rules on a limited basis to the extent, internationally, to the extent that it impacts our economy, which has a, quote, direct and significant impact on commerce in the U.S. It's a limitation, drafted as a limitation. I think any lawyer will tell you that. We're limited to applying our rules extraterritorially based on this limitation. So we draft a rule and we put it out. We actually didn't even draft a rule. We put it out as guidance, which the nuance of guidance in rulemaking is significant. We've tried to explain to the market what guidance was, but we're not required to do a cost-benefit analysis under guidance. It's not the same as a rule. We don't have to do as much with the Administrative Procedures Act. It's a lower standard. So we put out guidance on this, even though it's going to have a large impact. And we didn't treat the statute, and this is the first principle of good government, we didn't follow the statute. We actually said that any trade has a direct and significant impact on our economy. That's not what the statute said, and that can't be true, because the first trade cannot be direct and significant, or every trade can't be direct and significant. Keep in mind the swap dealer rule that I told you about, the $8 billion de minimis. We said if you're under $8 billion in the United States, you're not a swap dealer, therefore you are not systemic. So how do you apply an international standard that says your first trade with a U.S. person is direct and significant impact to our economy? So we have conflicting rules, and then we just patently read the statute incorrectly and far extended the reach of this rule. So, not surprising, the international world sent back a very strong no way. This cannot be. In kind of regulatory and diplomatic speak, this was a very direct letter. This is not something you find in normal international communication. And so we invited them into the commission last week, and we had another very frank conversation about the application of our rules and the reach that they would have, far exceeding the U.S., essentially applying the U.S. rules internationally. That was not well received in many capitals. And of course, they haven't written their regs yet, so we're still waiting for them to write their regs, and it is always a mixed bag to have them go last, especially with our overreach in regulation. And they intimated as much, that, well, maybe our regs, which are very similar because we've drafted them in coordination, starting with the G20 meeting in Pittsburgh, where all the G20 nations decided we were going down this path. So they get to write last, which is, we have to be careful about that. We do not want to create a competitive disadvantage for U.S. firms internationally, nor do we want to provide an advantage to European banks, for example. It has to be a level playing field. This is not picking winners and losers. This is just getting the rules right to manage systemic risk globally, which was fundamentally the problem back in the 2008 crisis. So we have strayed from the we've strayed from the statute, and we're starting to begin with a renegotiation. I think that's the appropriate way. We really need to sit down with the European regulators and Asian regulators and make sure that we have a coordinated, overarching regulatory environment that respects their jurisdiction in their country. And then we're going to have to pull back on our regulations to make sure that we have clear rules of the road and that companies are not caught under duplicative regulation. Now, obviously, we didn't do a cost-benefit analysis, so we weren't burdened by any of those concerns in the application of our rules. So we really need to fundamentally go back, rewrite it, draft it as a rule, coordinate internationally, and that's going to take some time. So we're just going to, I think the immediate response is to delay the application of Dodd-Frank internationally. We have to be very careful, otherwise we'll put our banks at a competitive disadvantage vis-a-vis Europe. Now, one area where we have, so that's we've proposed a screwed up rule, and we have yet to apply it, so hopefully we will not apply the cross-border rules as drafted. Now, the one area where I'm optimistic, and I think we have the best opportunity of fixing it, is in the swap execution facility. Now, that of course assumes that there are still swaps left to trade, because with the energy products, we've seen them go to futures. So we're drafting swap rules. These are the exchanges for swaps, right? Where you would trade them. Pits are, we're not doing pits anymore. There are pits in Chicago, but globally pits are going the way of the dodo. So people are trading, this is an electronic market, and it trades globally, and it trades quickly. This is the term high-frequency trading you're very familiar with. It's been blamed for a number of ills in our markets, and it's remarkable, frankly, the speed in which they can trade and put in orders, and the impact that has on markets is for another speech, frankly. But we'll move on. But so we're trying to define what the swap execution rules are. Now, I'm optimistic. This is a great opportunity for new businesses to grow and create new innovative models. It's very exciting. There's a lot of great ideas. In fact, after this, I'm going up to New York to speak at CEFCon. This is the swap execution facility meeting that they have every year to talk about, the new and innovative ideas and what the regulations are going to provide up in New York City, where many of these firms are located. There's some great ideas out there, and I'm very excited about the opportunity to trade a whole new suite of products on some very innovative platforms. So, but it's very important that we create the environment in the regulation to make that happen. And if we stifle these if we have stifling regulations, or they look too much like the old regulations, we're not going to have a very successful product offering. There was about 2 years ago when Dodd-Frank came in, people were saying, "Wow, all these great ideas. How many CEFs do you think there will be?" At one meeting, and I'm head of the Technology Advisory Committee, we had a meeting. They said, "I think," one guy said, "I'm a buyer at 100." Well, the draft rules came out, and people were like, well, these are a lot more limiting than we really thought. And now there's this move to futures. People are saying, well, that's even more problematic. So where are we going to find the liquidity to trade these products on our platforms? And so people are saying, well, the rules are not only the exchange rules are difficult, but the capital rules are expensive. A lot of the other regulations regarding who can trade under what circumstances are very complicated. So we don't know if people are actually going to want to trade these products. So we're trying to figure out how to make, to draft these rules in a way that people are going to have the flexibility to adapt and thrive under these. And so, because swap execution facilities will bring transparency to the market. That is something that we sorely lacked pre-2008 when we didn't understand what the risk we were having. If you can provide a range of technology offerings that offer prices to the market in real time, that will be a huge benefit to the market. They'll understand how these are being priced, and they'll understand what the order flow is. That will bring liquidity, in my opinion. So we have to be very careful and very flexible to offer a number of platforms. I think the bid offer right now on how many CEFs are going to be is right about 20. I actually have a wager with the chairman. He says they're going to be more than 20 CEFs. I said they're going to be less. And every day I become more certain that I'm right, because our rules are so difficult and so constricting for market participants. They're actually just saying, I don't know if this is the market for us. So those are some of the examples that we're working through, and obviously we have to work through the debate on the swap execution facility to make sure that we're doing the right thing, that we have innovative product offerings that will come to the market. And we have to work to make sure that we get these done right. So I've kind of given you three areas where we can make a difference here. There are plenty of other areas that we've debated about who has to register, et cetera, and the impact that has, but those are deep in the weeds and will obviously provide a number of opportunities for research for any of you going forward. And if you want to discuss this further, I'm certainly willing to sit down with you and go over some of this. So, if we're going to claim that we have the good government solutions that we all, of course, show up on a Tuesday morning and say we do, then we can't stop making. We've got to stop making bad decisions with our rules. We have to be more transparent. We have to commit to a rigorous cost-benefit analysis. And we actually have to listen to the market to make sure that we're going to put these rules that are going to be useful for them to trade in. So with that, let me end it there, and I'm happy to take any questions you have for me.
And if you have a question, please come to the microphone so that everybody can hear
right behind
your question.
What exactly is the market failure that your regulatory efforts attempt to cure?
The market failure we point back to is the financial meltdown of 2008. And in our space, a lot of that had to do with not the housing market, not the housing bubble, but largely the balance sheet exposure large investment banks were carrying without really understanding what the risk was. So AIG is the poster child for what we're trying to fix. And we have a series of rules that will designate systemically relevant. This is that swap dealer definition that I talked about. These are the systemically relevant entities. We want to make sure that we understand what they're carrying on their book in terms of risk management, and then we price it. There are 4 principles to the G20 financial reform that were laid out. And these I don't disagree with at all. It's the application of the very specific rules that we have had a challenge with. Report all trades, so that we'll be able to see the exposure in the market. Fundamentally, I agree with that. We can put all the trades up, not by who's doing them, but by overall risk, and the regulators will see who's doing them. So the market will be more informed about where risk is in the market, which products, what type of entities. The second one is to trade on screen as appropriate. There is the as appropriate, which is of significant debate among international communities. What can you bring to the screen? How much more can you get there? If we provide a flexible execution platform, you're going to be able to bring much more pricing, much more data to the market. You don't have, not everything has to be in a central limit order book, which is the thing you'd see on the stock market, right? That's the central limit order book. Sometimes requests for quote and some of these other flexible venues would be more useful. The third one is clearing. Put those entities that are systemically relevant have to clear their trades. And the last one is any entity, OTC products have to be priced higher. So you want to take it out of the dark markets, if you will, the over-the-counter markets, and bring it into lit, transaction-based, and then you'll get better pricing data on your clearing and risk management. So those are the broad principles I agree with, and those are intended to address the meltdown of the 2008 financial crisis. We're not responsible, as I said earlier, for housing and things like that, but that's in our wheelhouse. Does that answer your question? What is lacking? What can I help you with?
In what way was you relate all this back to the supposed financial crisis? In what way was that a market failure rather than a example of the operations of it?
Great question about how does the market respond, and that's fair enough. And I had my regulator hat on when I answered your question. So what we were given and where the debate should have happened, and obviously the response, Dodd-Frank came in, this is the response to all of that. So I answered it with the regulatory hat on, this is what we are doing to respond to that under the rules that Congress gave us. Points about, too big to fail, and should people be bailed out, and who should receive this protection, and does it actually offer protection, is a very valid question. So I'm not going to do that one, though. We could be here a lot longer. But it's a great question. And now you're going to say, well, how did you really fix it? Is this futures to swaps, swaps to futures, is increasing the risk of hedging and managing risk, and is that worth it? Because everything we are doing is adding cost to risk management. It's broadening kind of the government reach in terms of what we see and what we know, and I think that's we'll be able to get a lot more information, but at what cost, and is it the right outcome, and will we make people make tough decisions about whether they should or should not manage risk going forward? And that's certainly not the outcome we're hoping for. But I think with some of the concerns I've laid out here, that is the outcome that we will be facing.
Commissioner, you mentioned a couple times the weakness of the cost-benefit analyses done at CFTC, and I wonder whether you think that independent agencies should be brought under the same standards for rulemaking under Administrative Procedures Act as the other regulatory agencies.
We are under administrative procedures. Our cost-benefit statute is weak. It doesn't demand much of us, and we haven't exceeded expectations in any respect. This is a tough thing for us to do, frankly. This is not something we have very good experience with institutionally within the CFTC, and now we've had to do 39 rules, final rules, so we're not good at it, and we've done it very quickly. Some rules I've actually pointed out have no dollar figures in them whatsoever. That's obviously not a cost-benefit analysis. It's an editorial, and that doesn't do anybody any good. So there are certain reforms out there. I think Congressman Conaway had a bill that would have been very specific in what we had to look at and consider, and I'm very supportive of those types of initiatives because our standard is low, and we can do a better job, and we need to be told to do a better job. So this actually requires congressional action.
Please join me in thanking the Commissioner. We don't want to make him late for his next engagement. We've had a slight change in programming, so your program's a little bit off. The weather kind of did a number on us this morning, and we had some folks that were trapped, so we're going to flip the panels. So instead of the first panel you thought you were going to see, you've got a second panel as the first panel. So what we will be focusing on now are some of the key challenges and key solutions. It seems pretty clear that the evidence is that our regulatory system suffers from some chronic ailments that cannot and have not been cured and are unlikely to be cured by any one president. In our next panel, we'll look at those key challenges and solutions to the problems in our regulatory regime. We'll start by hearing from Dr. Jerry Ellig, a senior research fellow at the Mercatus Center at George Mason University. Dr. Ellig's primary research interests include the federal regulatory process, economic regulation, and telecommunications regulation. And for those of you in this room, you're probably interested in the fact that between August 2001 and 2003, Dr. Ellig served as the deputy director and then acting director of the Office of Policy Planning at the FTC. Dr. Ellig has also served as a senior economist for the Congressional Joint Economic Committee and as an assistant professor of economics at George Mason. He holds a master's and PhD in economics from GMU. Today, Dr. Ellig is going to be addressing the issue of regulatory impact analysis and how good that analysis actually is. He is joined on the panel by Hester Peirce. Hester is also a senior research fellow at the Mercatus Center. Before joining Mercatus, Ms. Peirce served as senior counsel to Senator Richard Shelby on the Senate Banking Committee. Her oversight work on the Banking Committee focused primarily on the activities of the SEC, the CFTC, and the Financial Stability Oversight Council, amongst other agencies and boards. From 2004 to 2008, Ms. Peirce served as counsel to Commissioner Paul S. Atkins at the SEC. She also served as staff attorney in the Division of Investment Management at the Securities and Exchange Commission. She holds her JD from Yale Law School. And Ms. Peirce will examine the issue of how safety and soundness is not only compatible with economic analysis, but necessary for it. So without further ado, I will turn it over to Hester with one other short programming announcement. At the conclusion of this panel, at about 10:20, we will take a brief 10-minute break so that we can get ourselves back on schedule. And now, Professor Purse, it's up to you.
Hey, Jim, when I go
We're
first?
gonna.
Okay, you're going to switch. Okay, you're going to overrule me. That's fine. We'll have Jerry Ellen go first.
Okay, well, thanks, Jim. One of my favorite old Calvin and Hobbes cartoons starts with Calvin standing there with an apple, announcing, "I'm going to prove that there is no moral law governing the universe. I'm going to throw this apple at Susie Durkins unless the universe gives me a sign that it's wrong." And so he waits, and he counts down, and he says, "Ha, no sign, there's no moral law governing the universe." He throws the apple at her. Of course, then the next thing that happens, she chases him, beats him up, and he's lying there on the ground saying, "Why does the universe always give you the sign after you do it?" Well, the purpose of regulatory impact analysis is, you're wondering where this is going, right? No, the purpose of regulatory impact analysis is to help us understand the consequences of our choices before we do it, so that we don't get an unpleasant surprise after we do it. In some ways, the requirements for regulatory impact analysis laid out and elaborated in a series of executive orders over the past 30, 35 years are pretty simple. You should understand the problem that you're trying to solve if you're a regulator, or if you're an analyst advising a regulator. You should look at alternative solutions, alternative possible solutions, and understand the pros and cons of the alternatives, or as we economists like to say, costs and benefits. Now, we can laugh at Calvin and Hobbes because all that happened to Calvin was he got beat up by a girl, and they're cartoon characters, so nobody actually got hurt in that particular comic strip, or well, in the comic strip, but nobody got hurt in the real world. Well, what happens if we don't conduct sound regulatory impact analysis before making decisions that affect millions of people's lives, happiness, property? What could happen if we, like Calvin, just say, well, I'm going to wait for a sign, and well, now I'm just going to proceed in willful ignorance of the possible results? Well, people could die. I'm not exaggerating. People could die. You can look up an article published in the Journal of Law and Economics a few years ago where a group of economists looked at the impact of the post-9/11 airport security measures on a number of things. One of the things they looked at was the impact on automobile traffic fatalities. And they found that in the fourth quarter of 2002, there were 129 additional traffic deaths on the highways because flying became a hassle and people substituted driving for flying on short trips. I don't know of any analysis done ahead of time that pointed out that nasty surprise before we federalized the airport screening process and implemented new regulations for baggage and for passengers. Now, that's maybe an extreme example. People don't always die as a result of ill-informed decisions, but there are a lot of important things at stake. Our liberty, human dignity. Remember, don't touch my junk. People's time, sometimes money. And you notice I put that last, because that's usually the first thing people want to think about, because they want to think about costs and benefits as solely dollar terms and not other important things. There are also a lot of fairness issues that sometimes that are sometimes tricky and not as obvious as our moral intuition might tell us they are. For example, I was involved with Chris Conover, who's a healthcare economist down at Duke, assessing the regulations that the first batch of regulations implementing the Affordable Care Act. And as you're probably aware, one of them said that parents have to be allowed to keep their adult children on their insurance policies up to age, until they turn 26. Well, the analysis accompanying the regulation simply said, well, this is an improvement in fairness. It's a little trickier than that, though. I'm not quite sure if it's an improvement in fairness to tell a childless guy on an assembly line that he has to pay more for his health insurance in order for the CEO's college-educated kid to be able to be on the company health care plan. I'm not saying that's a reason the regulation is a bad idea. I'm just saying that the the consequences for equity and fairness are more complicated than you would think if you simply read the assertion in that regulation that, well, this improves fairness. Even though there was, there's important value, probably a non-quantified value of fairness or equity at stake there, just was not analyzed seriously. Well, maybe I've given you a little preview of my main point. There's a lot of independent, well, not a lot, there's a reasonable amount of independent scholarship that actually examines how well do federal agencies conduct regulatory impact analysis, and to what extent do they use it to inform their decisions? Does it have any effect? The Mercatus Center has its own contribution to this research, which we call our regulatory report card, where we have professors around the country evaluating regulatory impact analyses and reading the regulations to see how the analysis may have affected them. The best analysis we've ever seen from an executive branch agency, if we were giving letter grades, would probably get about a B-. So there's a lot of work to do on the executive branch side as well. Independent agencies seem to be below that. And by the way, my goal here is not to just completely do nothing but criticize agencies. This ain't rocket science. Regulatory impact analysis ain't rocket science. You can find good examples of how to do it. And we have highlighted a lot of those good examples in a series of publications that are available on our website. So there is good stuff out there. Most of what I've talked about today, though, is just what is on average true, what's the dominant tendency, and the message isn't great. So what do we do about it? What are the solutions? Well, in some sense, since I'm an academic, I can boil stuff down to simple solutions. In some sense, the solutions are simple. Regulatory impact analysis should actually be done objectively before agencies make decisions about regulations, not after. And agencies should be expected to explain how the analysis informed their decisions. Well, how do we get objective analysis before decisions are made? Well, two possible reforms might help. One would be to explicitly require, at least for the big regulations, explicitly require agencies to do an analysis that assesses the nature of the problem they're trying to solve, identifies alternatives, and at least sketches out benefits and costs of alternatives, and put that analysis out for public comment before a regulation is written and proposed. And that way, when the agency goes to write the regulation, it can benefit from the public feedback on the analysis that it did, that is supposed to inform the decisions about regulations. Another change that would be more institutional in nature, but would probably be beneficial, would be freeing us in a separate entity in federal agencies where they're managed by economists, and the standard for career advancement is how good a quality of analysis do you do, not did you write the analysis that does the best job of supporting the decision your boss, the person in the policy office, made. I mean, we put economists and other analysts and agencies in a really difficult position when we stick them in a policy office and tell them, okay, your job is to analyze the decisions your boss has already made and tell them whether it was a good decision or not. It's not a great thing. I mean, one potential model for this, and Paul Potler's here from the Federal Trade Commission, Bureau of Economics, I actually like that model a lot for this kind of thing, where you have FTC has a Bureau of Economics. Economists are managed by economists. The chief economist is usually an outside academic who comes in for a period of time. And the Bureau of Economics makes its own separate recommendations to the Commission in public meetings, at least on, and I'm not sure if it's on everything or just certain significant cases, and it's okay to disagree, and then the decision makers, the commissioners, actually make the decision. Now, you track down Paul and he can tell you whether that system really works well, pros and cons of it and whatnot, but it seems to me a better system than what happens in some agencies where the analysts don't have that kind of, don't have as much freedom to be objective. Okay, the other thing I mentioned was actually expecting agencies to explain how analysis was used. Agencies ought to be able to explain how their analysis of the problem, how their assessment of alternatives, and how the benefits and costs actually affected their decision. I don't mean they have to follow some sort of a rigid decision rule, but they ought to be able to explain how the analysis is related to their decision in a way that's sensible and defensible. And when the agency did not choose the alternative that produces the biggest excess of benefits over costs, the agency ought to be able to explain why it didn't choose that, what other value motivated the decision, and also present evidence that that other value, whether it's some notion of fairness or something that's not quantified, that ought to be able to present some evidence that that value is real, not just, some random preference of someone in the agency, and that the regulation really will do something to advance that value. Not just good intentions, but we have some proof that fairness defined in this way really will improve if this regulation is enacted for this reason. And you don't see that in the cases, at least where I've read regulations where decisions were made on the basis of non-quantified benefits or costs or values other than benefit and cost considerations. I don't think it's too much to ask for an explanation with some decent underlying analysis of what those things are. So when we go to regulate, we're in a position similar to Calvin, cocked with the apple in the hand, ready to fire. Now maybe there's a good reason to throw the apple sometimes. Maybe Susie Durkins is a terrorist. Maybe she's a corporate polluter. Maybe she's a monopolist. Maybe she's all three. It's an election year. I've been watching too many commercials, so I got carried away with that one. Maybe it's a good idea to throw the apple, but we have a responsibility to understand the consequences before we do it, because the universe ain't going to give us a sign.
Now we'll turn to Hester Peirce.
Thanks, Jim. You've all probably heard the joke of the physicist, the chemist, and the economist who are stranded on a desert island. They have a can of food, but no obvious way to open it. So the physicist suggests smashing it against a rock. The chemist suggests putting it in the fire. And the economist said, well, let's just assume we have a can opener. So I want to give you a little variant of that joke. And that is, you have two agency attorneys and an economist stranded on an island, and they have a can of soup. The agency attorneys are at a loss. They don't know how to open this soup. The economist actually has a can opener, and he gets it out and gets ready to start opening the can. And the agency attorneys take him and the can opener and throw him off the island. It's like the regulatory version of Survivor. But unfortunately, it's not just a reality show. This is the reality at independent regulatory agencies. They're making a conscious decision not to use a tool that they have at their disposal, a tool that would help them to figure out what they need to spend their regulatory resources on and what the best solution to the problems that they've identified are. And instead, they're choosing to, as Jerry described, they're choosing to fire without looking or thinking first. I want to look at this issue in the context of financial regulation. And one of the reasons for that is that the financial regulators are almost all independent regulatory agencies. In fact, Dodd-Frank created a couple of new agencies, and it made them independent regulatory agencies. And it also converted the OCC, which used to be an executive agency, into an independent regulatory agency. And I believe that one of the reasons that was done was precisely to avoid the executive orders that apply only to the executive agencies. So arguably, those orders could be applied to independent regulatory agencies, but so far they haven't. So as a result, economic analysis requirements and OIRA review don't apply to these independent regulators. As Jim mentioned, I worked at the SEC, and I was a rule writer. But I'm an attorney, and so my job was to write the rule and then write the economic justification for the rule afterwards. And then at the very 11th hour, we would go to the economists and beg them to sign off because the meeting date was coming up and we really needed their sign off. And it's not an ideal way to do things. We categorize this part of the release as the back end of the rulemaking notice, and that's really how it was treated. It definitely followed whatever you put in the front end of the rulemaking notice. The SEC is not alone in this, though. This is par for the course at the other financial regulators as well. Another reason why I think it's really important to consider financial regulators is that
there's a massive rulemaking effort underway now pursuant to Dodd-Frank, and it's affecting all the financial regulators, and a lot of rules are getting made without any clear, rigorous analysis to back them up. And the consequences are going to be severe. I mean, you heard Commissioner O'Malley describing how the swaps market for energy swaps is really shifting into futures. And while that doesn't sound like a big deal, I mean, it's, they're both complicated products. Why do we need to care? An airline that needs to buy its fuel hedges its risk that the fuel prices will change, and often it will use swaps to do that. If instead it's forced to use the futures market, it's not the end of the world, but it's harder to precisely hedge the risk that you face if you have to go to the futures market. So what does that mean for you and me? It means we'll pay more for our airline tickets because we're going to be paying more of the fuel cost that's not hedged. So it matters in this way, and then it matters in terms of what products will consumers have available to them. The number and the cost of products will be affected by the failure to think in advance about what the consequences of rules are. Now, as Jerry mentioned and as Commissioner O'Malley mentioned, there are organic statutes that require some degree of economic analysis by the financial regulators. The SEC has a requirement to consider efficiency, competition, and capital formation, and has actually gotten a fair bit of attention for that requirement lately. And the CFTC, I would argue, may have a stronger requirement. It's required to evaluate the costs and benefits of its rules in light of a number of considerations that are listed in the statute. And the new Consumer Financial Protection Bureau, or CFPB, Dodd-Frank gave it a requirement also to consider the costs and benefits of its rules and to consider, among other things, the effect of its rules on consumer access to products. None of these agencies has taken its organic statutory requirement particularly seriously. The SEC has faced a number of legal challenges for its approach and has lost a series of cases starting about 7 years ago. The most recent loss was the first rule adopted under Dodd-Frank. That rule was thrown out of court for poor economic analysis. And that, I think, was the wake-up call. Even though there had been cases before that, that was the wake-up call the SEC needed. And they have rethought their approach to economic analysis. And going back to something that Jerry mentioned about structure, they rejiggered the structure so that the economist does report directly to the chairman, giving him an element of independence. And they also put out a new staff guidance document on how economic analysis should be conducted. And it has a lot of really good elements in it. And among them, trying to integrate the economists and the economic analysis into the rulemaking process, so it's not just that end add-on that it was when I was there, but it actually helps them make decisions. But one big flaw in the new guidance is that it does say, as Jerry mentioned again, that if the statute says you have to do something, they just go ahead and do it without trying to first identify a problem. And it makes it very difficult to figure out what a solution should be if you don't know what the problem is in the first place, and certainly to measure how effective your solution is. If you don't know what problem you're solving, it's very difficult to do that. But we can be hopeful that the SEC's process will improve somewhat. As a witness of good economic analysis, I think it's started to make a difference at the CFTC as well. They were starting from a very low bar, really cavalier treatment of economic analysis. But they've started to reach out to Iowa to get help, and we'll see if there are actual improvements. Just to talk a little bit about solutions, Jerry mentioned that we can require the agencies to actually take some steps, and I think that's important. You could do that for the independent regulatory agencies by moving them into the executive orders, so the executive orders could cover them as well. And that would then mean that they would get OIRA review also, which would hold them to a standard of discipline. Another option would be a statutory requirement that they conduct economic analysis, and that would be backed up by judicial review. And again, I think holding their feet to the fire in that way would really improve their approach. And then in the meantime, those would be fairly major steps, major developments. But in the meantime, there are other things you could do. You can, just going back to my opening thing about the can opener, if you can convince the regulators that regulatory analysis is actually a useful tool that can help them to identify problems, figure out where they need to spend their resources, identify solutions, then they're more likely to want to use it. And in fact, if you can convince them that regulatory analysis can help them defend themselves not only in a court of law, but in a court of public opinion, that would be useful. And then encouraging the regulators to work together, encouraging the economists from the different regulatory agencies to work together. And I think this is particularly important in the area of Dodd-Frank regulation, where you have regulators adopting rules every day, and those rules may be in conflict with one another, and they're not talking to each other, and they're not thinking about what the interaction between or among the rules and the regulators is going to be, and often the same industry is affected by these different sets of rules. Then I just want to end with a couple cautions. If we do impose more requirements on independent regulatory agencies, they, like the rest of us, will try to find a way around them. I think one way is backdoor rulemaking, and again, Commissioner O'Malley highlighted an example of this morning. Staff guidance or commission guidance, which is not formally a rule, is a way to get around economic analysis requirements. Another way is rulemaking by speech or rulemaking by enforcement action. And then another way, especially with the CFTC and the SEC, is to rely on so-called self-regulatory organizations, which I think are more appropriately called quasi-governmental regulatory organizations. They have traditionally not been held to the same requirements as their sponsor agencies, and so I think to the extent that requirements are placed on the sponsor agencies, they should also be placed on the QGROs. Now I'll turn it back over to Jim.
Thank you, Hester. We'll now move to what is always my favorite part. It's when you fill the room with your brilliance. Please feel free to step to the microphones to ask questions. I'm sure that it's going to be a tough panel to stump. Yes, sir.
My question is whether both of you are in favor of bigger government, or in terms of bigger agencies, hiring more economists, more lawyers. Jerry, you mentioned having an independent group of economists, so that the agency now has economists that work for some of the commissioners who are political appointees. They want to be able to, have their own economists like they have their own lawyer. But if there was an independent group, separate, like you mentioned, the Inspector General, that would be a new group of people. If we did that for lawyers also, get an independent legal analysis, whatever, that again would be a new additional group of people. Then you mentioned, instead of just going to a notice of proposed rulemaking, do first what we call a notice of inquiry, where you put all the options out, before you propose it, but that adds an additional amount of time and resources. So it would seem if the agency is going to do what Congress asks it to do, that's going to take a lot more resources, hire more people, get bigger, whereas I hear that we want smaller government, cut back the agency, cut its budgets. How do you resolve this tension between wanting more good analysis, which I support, but also smaller resources, or do you support bigger agencies?
Seems like there are several parts there. Who wants to jump in first?
I'm happy to go first.
Okay.
I would say that I speak about the SEC, which is the agency that I know best, and if I were allowed to reallocate some positions to economist positions, I think it would not be that hard to identify some other positions that could be eliminated to to fill those with economists who would add more value to the agency.
Yeah, I think regardless of what you think about larger or smaller government, the reality, given the U.S. budget situation, is there's going to be a lot of reluctance to put, a lot of net new resources into regulatory agencies. So, the reality is, how do you figure out how to do it with, a lot of the resources we have? And yeah, if you look at the ratio of economists to lawyers in a lot of agencies, there's, it looks like there's probably some room for reallocation. But I want to address the other piece of your question. Kind of gets at the idea of, is it a good idea to spend more time or more resources on, say, analyzing the likely effects of regulation and alternatives to regulation and alternative ways of writing regulation, in a time when we may have some fiscal austerity and have very, very limited resources. And yeah, I think it's a question of priorities. The way I would put the question is it a good idea to actually know how what you're doing is going to affect people before you do it to them, or not? If you think it's okay for, to just go ahead and do things to people without being sure what the consequences are going to be, then it's probably not a good idea to do more analysis. If, on the other hand, you think that we ought to actually know what the effects of our things, of our regulations are going to be on people and whether there's a way to do it better before we do it, then, gee, maybe we ought to find something else that's a little lower priority in order to make sure that we do this right.
No, but, clearly you're right, but you've got to convince the people who want to cut back on the resources that are there now, and that takes long-term vision, realizing that long-term your view is correct, but short-term you want to spend less. The other thing is, to Hester's point, that we're training lawyers in economics more and more, so some of those lawyers actually know their economics.
Yeah, I think that's a fair point, although I felt certainly when I was at the agency that asking lawyers to do to do rigorous economic analysis didn't make a lot of sense. There may be lawyers who are trained in economics more than I, but I still think that it does make sense to have people who really have the expertise working on the issue.
Please step up to the microphone, sir.
In the remarks so far, it sounded like the independent agencies are not doing such a good job regulating because they don't do economic analysis or don't do enough of it. And the executive agencies, while they're not doing a great job, they're doing much better. The question I want to ask is, aren't you going to get the result or closer to the result that you want, better regulation, only if the analysis is really done independently? OIRA has a lot of rules or a lot of guidelines for how to do cost-benefit analysis. They're very, very refined, very sophisticated, and there are agencies, the agencies do these analyses, and they go to OIRA, and OIRA looks at them and doesn't reject them. And I think the agencies could often argue, look, we've spent all this time, we've done all this work, we filled all these pages, so we're fine. But you're not really going to get the selection of the best alternatives unless the people doing the analyses are somewhat independent. So what's your reaction to saying we need something other than OIRA, or we need some kind of process that is going to make it more independent? The one suggestion of establishing separate economist shops in these regulatory agencies, I think that's a good idea, but ultimately they're not going to be making the decisions.
Yeah, I think it's a point well taken, and I flip back and forth on alternate days as to whether having an additional shop inside the federal government, independent of the executive branch, would give us a significantly better analysis if it were, reviewing the analysis that agencies do. I mean, on balance, I'd probably say it's probably a good idea, worth trying. There's also a step in the reasoning behind my suggestion that agencies should analyze the problem, analyze the alternatives, and analyze benefits and costs of alternatives before making decisions. And there was a step in the reasoning there I didn't elaborate, which is if agencies have to do that and put that analysis out for public comment before making decisions about the regulation, then you have not just maybe one entity in the federal government, but potentially thousands of other entities who are commenting on the agency's analysis, also giving it a second look and a quality check. So you kind of crowdsource the OIRA function in some ways. Not that I'd say you get rid of OIRA, but you have the potential for a heck of a lot more informed eyes being on just the analysis, since there's no regulation proposed yet. And I think that would be a helpful thing too.
Okay, we have time for one more question here.
Okay, just building on what was asked before, what do you think, two questions, what do you think about a congressional office doing this type of independent review? Maybe it could be an existing congressional legislative office doing this, as opposed to an office within agencies. And then let's start with that first.
I mean, I think that's an idea that has been thrown around, and I think it's not a crazy idea. It would be difficult maybe to set it up in a way that's free of political influence, but I think the Congressional Budget Office is sort of the model that we would think of, so it's definitely a possibility.
And then, sorry.
Yeah, I think if you're going to have another entity in the federal government that looks at the quality of agencies' regulatory analysis, one obvious way to do it is that it's under Congress rather than the executive branch. There are the political problems. I know in the state of Pennsylvania, they have an independent regulatory review commission where the leadership is, I don't know, Morris McTeague, I think, is in the audience. Morris would remember how the heck that thing is set up, but it's basically an attempt to set up something that's kind of independent of the executive and Congress and the legislature to look at regulations. So that's another potential model.
On the state level, there are those rules review commissions. There's a little more separation of power problems on the federal level, fortunately. But the big concern that I have is even when agencies do this type of analysis and they actually do it correctly, or they actually don't do it correctly, courts give so much deference to agency analysis that really, as long as the agency kind of just does the analysis, regardless of whether or not they're doing it well, that's pretty much good enough for a court. So how would you kind of ensure that agencies are actually not just checking the list, but making sure they're actually doing it properly, and courts are somehow playing a role to make sure that you don't want courts to be the policymaker, but you also want to make sure that they're playing some type of role, I think, to make sure agencies are doing their job.
And certainly the SEC would take issue with the idea that the courts never look at what they do. Now, maybe the SEC is a little bit of an outlier on that, but I think that there is a model out there for looking at analysis, for a court looking at analysis.
Yeah, I mean, there's a sliding scale of possibilities for doing this, and it depends on what's workable, what's doable. At one level, you could have a substantive standard in the law that says this is the standard the regulation has to satisfy. The agency has to prove with evidence that it satisfies this standard, and the judiciary gets to review that. And so you have a judge almost like in the OIRA-like function. Other more mild versions of it are, at least the agency has to explain substantively how these really important parts of the analysis affected decisions it made about the regulation. And maybe a judge can't second guess whether the agency made the right decision, but a judge should certainly look at it to see, did the agency adequately provide that information that links the analysis to decisions so that people can understand, okay, I see how the agency got to this decision based on the analysis it did. And I see where the agency maybe, rejected some of the analysis that its analysts did.
Thank you. I hope you'll help me join the panel. And let's take a quick 10-minute break, stretch our legs, and come back for the next panel.
Coffee.
So there's a concern about robustness.
Okay, I think people are finding their way back to their seats. We need to get started now with our next panel. So you heard about some key problems, some key solutions in the earlier panel. In this next panel, we'd kind of like to talk to you about exploring the consequences of regulation. The regulation isn't really a panacea. During the panel, you're going to hear speakers address some of the common fallacies of our current regulatory regime to actually address problems rather than to just enact regulations blindly or, as Dr. Ellig says, do the shoot, fire, aim way. We really need to have good data, and we need to know what the consequences are going to be so that we can avoid unintended consequences. I think everybody can agree that there needs to be rules of the road, but regulation really isn't a panacea. Without proof, well-intended but misguided regulation can stifle economic growth and the jobs and prosperity that come from that growth. We have an opportunity with a new Congress and a fresh start on a presidential administration to see some effective regulatory reform that will transcend any single presidency and move our regulatory regime in a direction that I think everybody wants to see so that we're really focused on problem solving that's grounded in evidence and that will produce the kinds of results that we're all looking for. And so for that end, we're going to turn to our panel. We're going to lead off with Dr. Patrick McLaughlin, who is a Senior Research Fellow at the Mercatus Center. Before joining us at the Mercatus Center, Dr. McLaughlin was a senior economist with the Federal Railroad Administration. He's published articles in the fields of law and economics, public choice, and environmental economics, and he holds a PhD from Clemson University. And he's going to be introducing his new reg data model, which will provide a visual representation of the cumulative volume of regulation over time as it's presented in the Code of Federal Regulations. Our second panelist is Dr. Keith Hall, a Senior Research Fellow at the Mercatus Center, who from 2008 to 2012 served as the 13th Commissioner of the Bureau of Labor Statistics. Dr. Hall also served as a Chief Economist for the White House Council on Economic Advisors, and he has been a full-time faculty member at the University of Missouri and the University of Arkansas. Dr. Hall received his master's and PhD in economics from Purdue University. He will be talking with us about the unintended consequences of regulation on employment and the unemployed. And our final panelist today is Dr. Matthew Mitchell, a Senior Research Fellow at the Mercatus Center, and he's the lead scholar on the project for the study of American capitalism. Dr. Mitchell also currently serves on the Joint Advisory Board of Economists for the Commonwealth of Virginia, where his advice helps the government there to make revenue estimates. Dr. Mitchell has testified before Congress numerous times, and his work has been featured in a number of national publications, too many of which there are for me to list for you today. He holds a master's degree and a PhD in economics from George Mason University, and he's going to address the consequences, unintended or otherwise, from government regulation that results in the picking of winners and losers in the marketplace. So we'll turn to our first distinguished panelist, Dr. McLaughlin.
Thank you, Jim. Today I'm going to be introducing a new database. Reg data is what we're calling it. And the full title of my presentation is a bit of a mouthful. I'm going to go ahead and read it to you anyway. Capturing and comparing changes in the volume, scope, and burden of federal regulations. So it's long and it's ambitious, but I think it's appropriate. The first speaker today, Commissioner O'Malley, made a point that I thought was really relevant. He said we're bound by what we know when it comes to in his case, regulatory impact analysis or cost-benefit analysis of regulations. The same point is true for looking at the overall effects of regulations. If you paid attention at all, which I'm sure everyone in this room did during the election season, regulation came up quite often as a topic of conversation. And the fact that you're all in this room here today at a conference about regulation probably speaks to the idea that we think regulation is important. Regulation is growing in terms of just how much there is out there, but we have a hard time saying what is the effect of the growth of that regulation. And the final point on that is there have been a few studies that have tried to estimate how much regulation has an effect on the economy. And the range of the estimates from these studies is so large as to be, it just has to leave us all in that utter confusion about which one to believe. And one of the hard parts about doing these studies is there's not a very good way of measuring regulation in the first place. That's the void that reg data is going to try to fill. So let me start off with a story. When I first started doing research on regulation, and first came up to DC after finishing my PhD at Clemson, I began working on a topic called midnight regulations, which probably many of you are familiar with. And I learned quickly that the so-called gold standard at the time, at least, was to count up the number of pages added to the Federal Register each year and have that serve as a proxy, as a measure of how much federal regulation had grown each year. It's a remarkable graph. It's a remarkable time series. It goes all the way back to 1936, and we have annual data going through the present. But there's a few drawbacks with this, and anyone familiar with this data knows these drawbacks. And that includes the fact that, number one, a page published in the Federal Register may actually be involving deregulation instead of regulation. It's at best, a count of pages in the Federal Register is at best a measure of bureaucratic activity. Another drawback to this is not only do we have some problems in knowing whether this is a good measure of total federal regulation, but we also don't know the nature of the regulations being created by just counting pages. Who's making these regulations? What's the nature of them, and who's being targeted by these regulations? One final point here on this graph. I don't show you this graph simply to denigrate the previous measures of regulation. I've actually used this measure of regulation myself in some publications. The point, one important takeaway here is, I don't know if you can read the y-axis, but the y-axis goes up to 80,000 there. There's a lot of pages. That's a lot of text. And if you think, what would Google do when faced with a lot of text? Treat it as data. And that's exactly what I've done in reg data. Reg data is a new way to quantify federal regulation, and the key innovation here is to take all the text that's in these regulations and use that as a data source. So some specifics of it are the reg data approach is to measure the total number of restrictions that are produced in the Code of Federal Regulations on an annual basis. Now, the Code of Federal Regulations, the CFR, is divided up into 50 different titles. Each title covers a broad subject area, such as Title 10 is on energy, Title 6 is on domestic security. And so one immediate outcome of measuring regulation in this way is we get to see how regulation for these broad subject areas is changing over time, as opposed to just regulation for the entire economy. A second key innovation here is, because I'm using text as a data source, I can go through that text and look for indications that specific industries are being targeted by the text of the regulations. So let me give an example here. This page is showing you the Government Printing Office's website, and I'll go into the website here and pull up some text from Title 29, which is the title on labor. And taking one single page from Title 29 at random, and I've got the words highlighted here. The words are shall. That's the highlights you see. And shall is an important word. Shall is a word that creates a legal obligation to do something or not do something. It's a restriction, if you will. So one single sentence from that one single page. Let me read it to you. This is just one single sentence. Before work is begun, the employer shall ascertain by inquiry or direct observation, I'm going to speed up now, or by instruments whether any part of an energized circuit exposed or concealed is so located that the performance of the work may bring any person, tool, or machine into physical or electrical contact with electrical power circuit. Easy for me to say. The important word there is highlighted. It's shall. So this long sentence basically telling employers not to leave open circuits lying about the workplace has a restriction. And the paragraph around this one sentence has actually 11 restrictions by my count. The page has 18 restrictions. This single title, Title 29, the title on labor, has about 48,000 restrictions in the entire text of that title. So that's the idea of this database, as one of them, is count up the restrictions in each title of the CFR. And if you do that, you add them all up. You get a final number for all restrictions each year published. You get a pretty striking graph. It starts off at about 835,000 restrictions back in 1997, and the number has grown fairly consistently. You can see the slope of that line is not changing a whole lot under various administrations, to crossing the 1 million mark in 2010. I don't think there was a parade celebrating crossing the 1 million mark. Now here's another way you can look at it. This graph is showing the number of restrictions in one single title. And that title is the one I mentioned earlier, labor. So when you look at it title by title, there's a bit more nuance. There are some times when the restrictions goes down in a title. That's different than counting pages. Pages are only going up no matter what. And we add another title onto here. Here we have two titles. We have labor, which you've seen before. It's been rescaled to accommodate for the internal revenue title. Internal revenue has a lot more restrictions in its title than labor does. And you can see, again, the upward trend over time. Now, this next graph is probably one of the most striking that I ran across. Here we've got labor and the internal revenue. They've both been rescaled. They look like flat lines at the bottom now. They had to be rescaled to accommodate the title on the protection of environment, which stands out by far as having grown the most and the fastest of all the titles that I looked at in this research project. In fact, in 2010, the number of restrictions in the title on environment accounted for 15% of all restrictions in the entirety of the CFR. So that's one part of it. It's measuring regulation by counting restrictions in each title of the CFR. The other part is I want to look at who's targeted by regulation. And so we're calling this regulation by industry. Now, the key part here is to take keywords that describe industries in the U.S. economy, and I took those keywords from a widely used standard method of dividing up the economy into different segments, different sectors, and that's the North American Industry Classification System. So one specific industry in that system is paper manufacturing. I created a set of keywords, permutations of that description, like paper manufacturer, paper manufacturers, and search for them all in each title of the CFR. The result is you learn how relevant each title of the CFR is to each of these industries by counting up how many times those industries are mentioned in the titles. So now we have two numbers. We have the restrictions in each title, and we have the relevance of each title to each industry in the economy. I combine those two numbers together and create an industry regulation index. This index tells you how regulated industries are over time, how targeted by regulations industries are over time. So here's an example. The red line at the top there is the manufacturing industry. It's a broadly defined industry, includes all sorts of manufacturing, but this is setting the amount of regulation targeting that industry in each year to how much there was in 1997, so it's always equal to 1 in 1997, this graph and the next graph. It's about a 45% growth is what this shows you from 1997 to 2010. The blue line is the average industry. It's about 20% growth for the average industry. There's another way of looking at it. This is more narrowly defined categories. We have paper manufacturing, chemical manufacturing, and air transportation all on this graph. And again, we see this broad upward trend. The blue line is the average, so a couple of these are in excess of the average. One of them is below the average. But there's a few takeaways here. One is that there's significant variation in how much regulation is affecting or targeting specific industries. Some industries more, some industries will have less. Secondly, this gives you some historical perspective. This lets you look back and see where your industries were 10, 15 years ago, 14 years ago. And then thirdly, if you care about maybe one industry and you specialize in one industry, you may get some blinders on and think about your industry all the time. Occasionally it's good to look at the other industries, look at the other parts of the economy that are also being targeted by regulation. So this gives some perspective. So why is all this important? Well, one of the ways that I measure my own success or failure is how well my mom can understand my work. So I sent her to this website, regdata.mercatus.org, had her look at some of the graphs and explanations there, and her takeaway was, wow, so this is why during the election so many candidates were talking about regulation. I'll take that as success. It provides a way to visualize regulation, and that's key. It's really hard to do that before, and I think that is a way for conveying just what we're talking about when we say things like regulation is important. Regulation, to paraphrase the Vice President, regulation is a big deal. Another reason why this is important is this provides a tool for research. This is something that academics or people who are specialized in regulation can use to assess the effects of regulation. You do that by, if you think about how a science lab would work, you have to have a control group and an experiment group. Here we've got a bunch of different groups, 120 different industries having regulation quantified for them. And so we can look at how when regulation goes up in this set of industries and doesn't go up in this other set of industries, what are the effects of that? Are there employment effects there? Does pollution go down in those industries that have more regulation go up? And the nice thing about the way this system is set up, this database is set up, because it uses the North American Industry Classification System, it can easily be joined with other data sets that use the same system. The BLS, for example, has a database called the Business Employment Dynamics database that measures employment by industry, same sort of industry definitions I've used, over time. So the intrepid researcher could go and take that database and merge it with this database and try to figure out what are the effects of regulation on industry. So in closing, I will be manning the booth that probably many of you have already visited, but I'll be out there later on today too. I can show you around the website, regdata.mercatus.org out there, and be happy to answer your questions out there or later on here.
Thank you, Patrick.
Thanks.
We'll turn now to Dr. Keith Hall.
Good morning. I thought a good way to start today, especially after listening to Patrick, would be to tell a sort of a transition story. When I was at the Bureau of Labor Statistics, I got sat in on the senior staff meetings at the Department of Labor. One of the things that they routinely did during these staff meetings is they would hand out spreadsheets with the numbers of pages of regulations, labor regulations that they'd been successful with, and not just passing them out, but also comparing different administrations as they were sort of keeping score. And two things come to mind with that. The first is just the number of pages doesn't really tell you much about the impact of the regulation, but that was their sort of poor measure. But the second thing was that it was this assumption that more is always better, that they were there to increase the regulation. There's no discussion of cost, no measure of cost. And so I thought that was a really bad sign for the mindset. So the first thing, I'd say something very obvious, but it's worth saying, regulation has a cost. It has a labor market cost. If you look at, in fact, this is on the Department of Labor website, by the way. It's talking about turning green jobs to gold safely. Let me just point out one thing, and I get tempted to say that I see this on the TV set sometimes anyway, when they all talk about green jobs and it's going to grow the economy. Regulation is not a government program to create employment. Okay? It just isn't. Right now there's an effort, when I was at BLS, there's a new program on counting green jobs. It's got to count green jobs. Nobody's counting jobs cost, right? Jobs that are lost because of regulation. And there's a lot of whatever, like green jobs are good jobs. See, everybody can have a green job. There's no cost to that. You get a great output, everybody gets a job. But in theory, of course, the impact of regulation compliance is actually pretty standard, right? There's a direct effect. A regulated industry has higher costs from compliance. Higher costs means higher sales mean higher prices mean lower sales. Output goes down, there's lost production jobs. Indirect effect, right? If it's an intermediate product, industries that buy the regulated product have to pay a higher price, right? So their costs go up, their prices go up, they lose jobs. Ultimately, consumers have higher prices. Consumers have higher prices because of regulation. Their buying power goes down. The buying power goes down. Lost sales, and there's a job cost. And of course, the third thing, which is usually really hard to measure, I'm not even going to talk much about it, but regulation has a dynamic cost. Right? Regulation can affect productivity growth. It can impact innovation, competition, and other changes that affect the growth of the economy, not just the level of employment or the level of GDP. So I want to have two basic points in my talk. First is when benefits and costs of regulations are calculated, especially by economists, on the cost side, they routinely underestimate the labor market cost of regulations. And I'll talk about why they do it and how they do it. And the second thing is, like almost any public policy issue, there are winners and losers. The people who benefit and the people who lose are different. And that's underappreciated, especially by economists who do work in this. Now, I'm going to talk about economic analysis of regulation, in particular, what's a standard assumption, especially in benefit cost analysis. It's the full employment assumption. Now, to tell you what I think of the full employment assumption, I've given you a nice picture here. This is the job loss from recessions. Right? So if you're going to do an analysis of regulation and just assume that, let's assume the economy is fully employed and any jobs lost in regulation will be immediately and cautiously made up by other jobs and equivalent jobs. So there's really no employment cost. There's no unemployment created by regulation. So if that's just trivial, why do we worry about recessions? If labor markets are so efficient, and one of my points about this is the full employment assumption is just that, it's an assumption. One of the real values of economic analysis in looking at regulation, and it's a challenge posed by any public policy issue, is there are winners and losers. And economic analysis lets you ask a simple question, right? Do the benefits outweigh the costs, even if those bearing the costs aren't the same ones reaping the benefits? Right? And this assumption is used, especially the full employment assumption, is used because there's this general notion that, labor markets are efficient. When somebody loses a job, they'll find another job quickly. There's not a long period of unemployment. Right? And it's not justified. Well, of course, as I'll mention here in a minute, that's simply not true. Second thing that's routinely done in economic analysis is they net out employment effects. So the analysis is going to look at an industry, and there's this presumption, well, every job that is lost from production because of higher costs and lower sales, well, they got to hire people for compliance. And then you net those out, and it's a kind of a wash, so it's not a big impact. Right? That, again, is an assumption that's often used. It's an assumption, it's not a result. There are clear problems with that. First, it isn't necessarily true. Second, it's only looking at the employment effects in the regulated industry. It's not looking at the employment effects, indirect employment effects in other industries. And I can tell you, I think that the indirect employment effects are probably routinely bigger than the direct employment effects. And the indirect employment effects are all negative. And third, again, it ignores the fact that the winners and the losers are different people. Right? The people who get those regulation compliance jobs are not the same ones who lost production jobs. They're different people. So you can't just net them out and assume there's no impact. Instead, I think the focus should be on job displacement. If you're going to look at the employment impact of a regulation, There's no reason why you shouldn't look at job displacement. And it comes from a simple fact. There's now a sizable amount of evidence that shows that job displacements in an economy result in significant and sustained earnings losses. All right, the immediate impact, lost wages, job search costs, and retraining costs. But even once employed, there's significant job skills mismatch and a significant earnings loss that goes on for decades. I'm going to cite a particular study here, which I rather like, is looking at job displacement. This is by Davis and Letcher, and they found in their study they looked at long-tenured workers, and they found that for long-tenured workers who lost their work, they had an average salary of about $45,000. The next year, their salary was down to $27,000, which is a huge loss. And 20 years later, in real net present value terms, the salary only climbed back up to $35,000. So the point was that the job loss, lifetime earnings loss was significant. During a bad time of recession like now, you lose the equivalent of almost 3 years of a salary from lower earnings. And even in good times, again, there's still significant job cost of displacement. It's about a year and a half of lost earnings. The losses from displacement are significant and sustained for workers, though with all sort of different lengths of job tenure in all major industries, and for workers at any age. It's not just this small group here of long-tenured workers. And job displacements are also shown to have impact on future job stability, earnings volatility, health and mortality of those who lose their job and their family. In fact, family outcomes such as school and future labor market performance of children is clearly impacted. And the spillover effect, the spillover effects in communities. None of these things are taken into account. Again, full employment assumption assumes that this is trivial. It's not a result, it's an assumption. So one of the things I think is a real problem in economic analysis is that they make some assumptions that are not justified by a particular industry or a particular regulation that they're looking at. And there are also probably some regressive effects of regulation. I mean, that becomes pretty simple. Higher prices from regulations impact all consumers, right? And if it impacts all consumers from higher prices, it's like a sales tax. And as we all know, sales taxes are regressive. So for example, here I showed you spending by income quintile on energy products, right? So if you're going to regulate energy more carefully, you regulate energy raising prices, and people in the lowest income bracket, they spend about 9.5% of their income on energy products, as opposed to the highest group is only 1.8%. So you have an effect that's really like a regressive tax. Add into that, by the way, that lower income families are probably less able to invest in substitutes. So it's not just they spend a higher share, but they probably can invest in something like energy conservation as easily as other income families. And then last, and this is on the demand for regulation side, private spending on risk mitigation goes up with income. Right, so what that means then is you've got families of all types paying money to mitigate risk, for example. If you do it with regulation, and you regulate things that normally only wealthier income families spend money on, that has a regressive effect. I'll give you a real simple example. Right, there's a proposal now, and maybe come up at the end of the year, to require backup cameras in all cars. Right now, only high-priced luxury cars have backup cameras. We have to buy the option. Right, so low-income families don't buy backup cameras. This regulation goes through, they're not going to have to pay at least $200 more for every car, because they're now required to have a backup camera. Now, I'm all for, not backing up over children. That's an obvious thing, all right? But the point is, for example, in low-income families, if they have to spend that much money in backup camera, they have less money to spend in other risk mitigation. So you actually could get a rather odd result where the risk actually goes up for lower-income families because they can no longer mitigate other, more important risk because you focused your regulation on risk that only higher income families support. So I think I'm there. That's what I mentioned earlier. Again, the basic punchline is I think the employment effects are trivialized in the economic analysis of regulation. And it's done really by assumption, not by any sort of argument, not by any sort of statistical evidence. And second is the impact on winners and losers is underappreciated. It's somewhat the nature of economic analysis that allows you to do that, but sometimes it's important and sometimes it should be pointed out.
Thank you, Dr. Hall. Now we'll hear from Dr. Matt Mitchell.
Well, thank you, Jim. And thank you, Keith, for teeing up my presentation, because I'm going to focus almost exclusively on winners and losers and the way that regulations impact winners and losers, particularly in the context of business. So as Patrick's mother astutely noted, politicians have been talking quite a bit about regulations lately. And the election season gave us an opportunity, in my view, to sort of see and map out how people of different ideological persuasions perceive the impact of regulation on business. So here's an extremely scientific approach to that. And what you see is, in my view, these are pretty common statements associated with the left and right about the way government regulation affects business. So on the left, you hear, well, regulation is needed in order to rein in the excesses of business. And on the right, you hear, well, regulation is reining in business too much. It's crushing business. It's harming them. Well, despite these two differences in the way that regulation affects business, notice that there's actually a similarity. Both sides agree that the power of government regulation is inversely proportional to the profitability of business. The left says a more powerful government, a more active regulatory framework is bad for business, but that's good. And the right says a more powerful government, a more active regulatory framework is bad for business, and that's bad. But they both agree that more regulation leads to worse outcomes for firms. And what I want to submit is that actually both sides are wrong on this, which is kind of depressing because we're always looking for common ground. Here's common ground, and they're both wrong in my view. So in reality, the way economists typically think about regulation, particularly public choice economists, with which George Mason University in particular is associated, is that regulation can be a boon to particular industries. And the reason is that, as Keith highlighted, regulations do, of course, impose costs, but those costs are inequitably distributed sometimes. And sometimes they're distributed in such a way that is a boon to businesses. So I'll give you some examples. The first one is that regulations quite often can restrict entry into an industry. So, for example, 36 states require certificates of need in order to open or expand a health facility. So if you are a radiologist operating in the state of Virginia and you want to add a couple more exam tables in your office, you have to go to the state and you have to prove that the community needs those exam tables. You have to say, this is necessary. Okay, now at first glance, this might seem like it fits in with both the right and the left's view, is the regulation clearly is hurting those radiologists, right? Well, not exactly. What sorts of radiologists like this? Those who have the certificate of need already, existing ones, exactly. So what this does is it creates a cost. It does impose a cost, but it imposes a cost on those who might be entering the business, those new entrants, and therefore it limits supply, raises price, and it's basically pushes the industry towards more of a cartel solution. So now a lot of cases, we think about this as happening in instances where there's maybe consumers might be harmed if there isn't some regulatory body that is somehow issuing licenses or approving those who are going to be trying to go into operation. But these restrictions to entry do not just apply to those types of industries. So for example, 10 states require licenses to braid hair. Now this is a cost that goes far beyond the economics here. Every day my daughter asks, Daddy, can you braid my hair? And I have to tell her, unfortunately, honey, I'm not licensed. So she suffers in these pigtails. But it doesn't stop at hair braiding. It's estimated currently that about 1,000 professions are subject to licensing restrictions across the states. These range from things like ferret training to horse massaging, which was an issue actually in this election in Maryland. I heard a story about this earlier. To all sorts of activities. In each one of these regulations, they impose a barrier to entry and push it more towards the cartel solution. Okay, so by the 1970s, economists and researchers began to sort of appreciate this, and there actually became to be a bit more of a consensus about this. So an article in the mid-1970s found the verdict is nearly unanimous that economic regulation over rates, entry, mergers, and technology has been anti-competitive and wasteful. Our unhinged regulatory system undermines competition and entrenches monopoly at the public's expense. This, of course, was offered by extreme right-wing zealots Mark Green and Ralph Nader. But this actually was the way that this was viewed at a time, and this is partially what led to some partial deregulations in industries such as transportation that were incidentally carried out under Democratic administrations and under Democratic Congresses. But since this view, which by the way is largely associated with George Stigler, who won the Nobel Prize in Economics for developing the idea of capture theory, the idea that regulatory bodies are sometimes captured by the firms and industries that they're supposed to be overseeing and can be used for their benefit. This idea has evolved over time. And now we have a little bit more of a nuanced idea of the way these types of regulations come about. So not only can regulations benefit existing firms by raising barriers to entry, but there's another way. And I'm going to highlight this by talking a little bit about an NPR story I heard recently. So this other model is the idea of raising rivals' costs. So a few months ago on NPR, I heard a story about the ban on the old-style incandescent light bulb. And there were a bunch of people in Congress that were talking about lifting this ban, and they wanted to be able to allow people to buy the old kind of light bulb. And so the NPR reporter, Peter Overby, had this idea that, well, why don't we go and talk to the firms? All these people in Congress seem to say that it's a regulatory burden, it's hugely costly to comply with these. Let's go talk to the firms and ask them, do they mind having this ban? And to a person, he found, boy, they really didn't mind it at all. The manufacturers, the distributors, the sellers, all of them were happy to have this ban on the old kind of light bulb. Moreover, all of them told him a story. They said that it was just as easy to make the new kind of light bulbs, and they had a presentation that they take to Capitol Hill where they have the old kind of light bulb and the new kind of light bulb, and they show congressmen how easy it is to make the new one. And so, if you lift the ban and you allow us to make the old one, it would create regulatory uncertainty. And then he ends the story. He says, so it's just kind of silly. It must not be a burden. Well, in my view, it would be really important to just ask one more little question. You just had a guy tell you that he employs people to go down to Capitol Hill and ask for a restriction on them? Lobbyists are expensive. Why in the world would you pay somebody, pay a lobbyist in order to ask for a restriction? Perhaps what they were asking for the restriction for is not on them, because of course they could make the new kind of light bulb whether there was a restriction or not. It was that they wanted to put a restriction on anybody else who might come in. And so this is the idea of raising rivals' costs, is that some firms have a higher cost of making some products, particularly the labor-intensive firms. And so if you can find a regulation that imposes a cost on you, but also imposes a cost on your competitors, and it will harm them more than you, it drives customers into your arms. So what are the consequences of this? I'm going to zoom through these relatively briefly. I've already mentioned one is that this leads more towards a cartel solution. Prices go up. Quality goes down. Even costs go up because firms are less cost conscious. This is known as exit efficiency. But this is just part of it. In addition, when government is handing out privileges, regulatory privileges to some firms and not others, then people will engage in privilege-seeking activities. This is called rent-seeking. And so on K Street and in DC, we have offices peopled with very smart, very well-educated, very well-paid lobbyists, lawyers, accountants, and so on, whose job it is to either ask for regulatory privileges or to defend against the regulatory privileges that their competitors are asking for. And when you analyze the cost on an annual basis, it's estimated that this is between $1 and $3.5 trillion annually. So it's somewhere between the stimulus that we had and the stimulus that Paul Krugman wanted. It's a big cost, right? But this is just a cost at any one point in time. Regulations also impose a cost because they affect the way the economy evolves over time. And the reason is that all these smart people that are people in K Street are spending their activity not coming up with new ways to bring value to consumers, but they're coming up with new ways to ask for regulatory privileges or to fend off the regulatory privileges that their competitors are asking for. So here is per capita GDP, per capita production in the economy over the last, 3.5 decades. And you see, of course, it's good news. The economy is growing on a per capita basis. You see right here this little dip. That's the Great Recession, the most calamitous economic event in any of our lives. And a few years ago, economists began looking at the way different societies allocate their human capital. So how many people in a society are engaged in productive entrepreneurship, trying to create engineering, trying to come up with new ways to please customers, and how many are engaged in unproductive entrepreneurship, asking for privileges. And they found that, sure enough, those societies in which more people are engaged in unproductive entrepreneurship, they're asking for more privileges or trying to fend off privileges from their competitors, societies grow slower. And how much slower do they grow? Well, it turns out that economies that have about 10% more people engaged in unproductive entrepreneurship, they grow by about 0.78 percentage points slower. Well, let's put that in perspective. What if in 1980 we had grown 0.78% faster? We had 10% fewer people engaged in these kinds of activities. You can see it makes a huge difference in terms of the type of per capita GDP we'd be able to enjoy. The average person in the U.S. economy would have an income about $12,000 higher. So this is the impact, time in, time out, over persistently slower economic growth. It makes a really big difference because of the miracle of compounding interest, right? And notice that Great Recession, the most calamitous economic event in all of our lives, it's a tiny little blip compared to persistently slow growth, right? So with that, I'm going to finish by putting up a couple contact information in case you guys want to follow up later with email or join the conversation on the blog, neighborhoodeffects.org, and you can follow me on Twitter at MattMitchell80, and I'm sure Jim and you all have some interesting questions. So thank you very much.
If you have questions for the panelists, please come to the microphones. And as people are making their way to the microphones, I'll remind you we will be having some breakout sessions immediately after this panel concludes.
Those are some very powerful arguments, and my research has been on tracing the origin of the conflict over environmental regulations and policy. But one thing that I think has been lost sight of is that in the case of environmental regs, 18 of the leading regulations or laws that EPA enforces do not allow consideration of economic benefits. So if you're trying to argue to make laws more, or the regs more rational, more efficient, and so forth, you may be arguing against the very heartfelt desires of the environmental bloc, which has its goals in completely different areas. And you can just look at the environmental activist organizations, very few of them, with the exception of environmental defense, pay any attention to economics in any serious way. So what I'm suggesting is that if you use these very powerful arguments as a club for political purposes, you could probably predict that you will get repercussions in the form of trying to discredit the data, to push it down, submerge it, and discredit the organizations that advocate it by the U.S. Chamber of Commerce that shows that 45% of the energy initiatives that are held up or killed by NEPA Act are renewable energy. Those are very powerful things, and there are people around, former tigers in the NRDC, for example. One has written a book which would sound like he would be very comfortable at this meeting. And I would suggest that it's just like the Nixon syndrome. You know, Nixon made friends with China. If there's real progress to be made, it will have to be made, maybe even initiated, by Democrats and reform environmentalists.
Thank you for your comments. And panelists who would like to jump in?
So it's certainly the case that some statutes of Congress limit the agencies and their ability to do analysis, and I take the point that maybe the data and the analyses that we present could perhaps convince Congress to change the nature of those statutes, or alternatively convince the constituents that Congress tries to appeal to change the nature of those statutes. So something specifically related to environmental regulation then, and my database. Right now, reg data does not necessarily differentiate between, say, an environmental regulation and say, a workplace safety regulation, except for by looking at which titles regulations are published in. But this is a living database. It's something that I'm consistently developing and improving over time. And so as years pass and I improve this, maybe we'll be able to create a sort of taxonomy of regulation, separate environmental regs from other types of regs. As we do that, as we create this taxonomy, we can get to a better understanding maybe of the unintended consequences of certain types of regulation. And with that understanding, we can turn around and convince Congress perhaps, or Congress's constituents, that you know, even though you think you're being made better off by some certain type of regulation, overall maybe you're worse off, and that could be a large part of the argument.
Other comments?
No, I don't have any more to add other than that it's a good observation that quite often the Nixon syndrome, I think, is very true. And you see this, again, when there was partial deregulation of some industries in the 70s, it was initiated by Edward Kennedy and, and Alfred Kahn, exactly, yeah. And we hear stories about, the Reagan deregulation era. Well, most of the deregulation that was initiated began under Carter.
A quick one from Matt. First, I assume most of the entry regulations are on a state level?
Yes. So about, that, at least that's where we have the best data on it. But yeah, about 1,000 industries at the state level. The average state has over 100, about 100 occupational licensing regulations.
Okay, and when I looked at this like about 15 years ago, there was a lot of argument in favor of certifications and disclosure. Instead of a license for braiding hair, you could get a certificate and you'd have to disclose to people, but if you didn't have a certificate, you could still serve them. And I think like that's the model for tennis lessons. Mm-hmm. You can have a certified professional or not. Is there any progress on that?
Near as I can tell, no, there isn't much. There's a lot of variety in the way different states approach it, and so some states have had more success than others. One of the things with this certification, though, is that it still raises a barrier to entry some way. It's a cost to get certified, and different states have different requirements for different industries, but you have to go to, sometimes you have to go to take classes or schooling or something. The basic problem is raising a cost to entry. One of the things I think that's really interesting is the advent of more voluntary solutions like Angie's List, where consumers can rate different professions, and they're totally in the driver's seat. And it's not just Angie's List, but at this point, when you Google something or you look it up on Google Maps, you're going to get the Yelp reviews, you're going to get all kinds of reviews. So it's not like there aren't private alternatives there.
Yes, sir.
Yeah, this is a question for Patrick regarding reg data. This may be the inner lawyer in me. I've got a question regarding how the system, can it distinguish certain text, like shall versus shall not? And even when it says shall, sometimes shall can be a prescriptive type of thing or a prohibitive type of thing. Can it distinguish that at all?
It's a great question, and the short answer is right now, no. Right now, I'm counting all restrictions as the same. There's no distinguishing one from another. However, as I mentioned earlier, I'm working on improving this over time. One of the ways I do want to improve this is to look for examples where there's a restriction in the same sentence as, say, an exemption or an exception. That would be somewhat of a different shall. And there's other ways that I can nuance the measurement of this. It depends on linguistics to a large degree, but as the programming improves, then we'll be releasing more improved versions and nuanced versions of this.
Sometimes the shall could be applying to an agency shall do something as opposed to the regulated entity.
That's right. Yeah, I agree.
I have two questions, one, or points, maybe more than questions, because I don't think you're doing this yet. Number one, the cost estimates of regulation tend to address only major regulations, because those are the ones that cost-benefit analysis typically applies to. There's an enormous amount of regulations that are non-major. I think it would be important to try to, your database I think includes all of them, to somehow relate, this cost range that's already pretty imprecise, to relate that also to all these regulations that fall under the radar, even with the executive agencies. So I don't know if you can do that if you're thinking along those lines. The other point was just mentioned about the state regulation. I think your database is only for the federal level. It would be nice to add the federal on top of the state, because a lot of the discussion, a lot of the numbers that we see, and this is very difficult to quantify. I'm not trying to make light of it, but it leaves out huge amounts of regulations and regulatory costs for those two reasons, that the analysis is cut off at typically a $100 million impact or something around there, and that the state and local regulations are not included.
Those are both great points. And for the second one, adding state regulations is something we are working on now. It's been a bit more difficult than acquiring the digitized version of this CFR from the federal government. We have a lot more governments to deal with, and they haven't necessarily provided the older versions of it for previous years. But nonetheless, we're going to have something for some states at least coming out soon that uses the same approach. We've already done it for Florida. It's not available yet, but we've got the data. Also, if you really want to get down to it, there's local regulations even on top of state. I don't know if we'll ever get to that point, but we're constantly going to improve the ways we are measuring regulation. And to your first point, you, I think, have identified one of the contributions of reg data, and that is that it's looking at all regulations and not just that 5% or less of regulations that are deemed to be economically significant and therefore subject to 12866 review and have to have an analysis accompanying them. So OMB puts out a report to Congress that totals up the costs and benefits of regulation, but those are only the regulations that have had analyses done, and that's 5% at best. What about the other 95%? So that's where we're trying to go, and you appreciated that it's difficult to get there. This is just a step in that direction, and I think a building block towards that ultimate goal.
Well, your timing is absolutely perfect, because we need to leave it there right now so that we can stretch our legs and move down the hall to the breakout sessions. There will be some nice folks who can help you to find the rooms. They're very easy to find, just out the doors on this side and down the hallway. You can join Dr. Ted Gayer for Our Regulation Benefits Real, Dr. Richard Williams for Bad Science, Bad Regulations, or Dr. John Luth for Looking Back to See Forward if you're interested in retrospective review. Let's thank our panel as we go out.
No such thing as a free lunch. Okay, now I am excited to introduce Scott Jacobs. I actually, when I spent a short amount of time at Office of Information and Regulatory Affairs and worked with Scott, where I was incredibly impressed by his work on regulatory analysis. So Scott left OIRA because he wasn't content just to fix the United States regulatory problems, and he went to OECD, and he wrote a number of, you can still go back and read these, really interesting pieces on regulatory reform. They're still on their website. But the OECD only had 34 countries as members. And that wasn't enough for Scott, so he decided to form his own organization. He has now been around helping to reform 75 countries, over 75 countries around the world. There are 196, so he's got a little work to do yet. But Scott is one of the world's leading experts on regulations and regulatory reform. And without further ado, let me introduce him. Scott Jacobs.
Thank you very much. And it's a great honor to be here at a Mercatus event, one of the great institutions of the United States, and long may you prosper. It is true. Actually, it's more than 100 countries now, because we're in a growth period for regulatory reform. And actually, I don't see it more as a profession as much as a reality show. Some of you may be familiar with the reality show that's filmed in my home state of Georgia of a little girl called Honey Boo Boo. And I'm going to propose one called Regulatory Boo Boos. And we're going to film this all over the world. It'll be our own reality show. I was asked to speak today about what the United States can learn from other countries about the next phase of regulatory reform. And it's an interesting question because for the last 30 years, other countries have learned a lot from the United States. One of the great things, of course, one of the great lessons around the world is the importance of a central management unit dedicated to regulatory reform, which is OIRA. I have also been promoting OIRA around the world, and around 40 or 50 countries today have OIRA-like institutions in place, and I'm very pleased at that. And do want to salute the importance of OIRA for our country. I know many former OIRanians and current OIRanians are here today. Can I just ask you to hold up your hands if you're an OIRanian? 3, 4, and some have left. I know Rich left and so forth. But let me just thank you for your service to the country. I think it's unrecognized. But the United States has not paid much attention to what's going on out there. I've had many conversations over the past 10 years with Americans in Washington, and frankly, there's been almost no interest about what other countries are doing. The hidden assumption always is that the United States is on the leading edge. We're number one. Other countries can look at us, and we're happy to share our wisdom. Well, that is not good enough anymore, and there's actually quite a lot to learn. One of the interesting things today is that countries all over the world are experimenting with regulatory reform. I started on the Reagan OIRA, and working on the great new tool of regulatory reform in the 1980s, which was regulatory impact assessment, working with one of my mentors, John Morale, who's here today. And more recently, I was in Vietnam, and Vietnam adopted RIA 2 years ago as a mandatory part of developing new laws and regulations. And I've often remarked that there are very few things on which Ronald Reagan and the Communist Politburo of Vietnam agree. But they agree on the need for regulatory impact assessment. Isn't that interesting? And the question really, the interesting question for us is why? Why are these tools so universally attractive to countries with very different ideas about the role of the state and the market? Actually, the United States and Vietnam adopted RIA for the same reasons. Both of them are worried about competitiveness in an increasingly difficult world. Both of them were concerned about regulatory effectiveness and regulatory failures, with very painful costs in areas such as environmental protection or financial markets or consumer protection in other areas. Both of them were concerned about allocating limited national resources to areas that actually met the needs of people. And so these issues are common across the world. And the tools we're talking about of regulatory reform, which seem so American,
actually are really quite global, and the issues underneath them are as well. Regulatory failure around the world is so common these days that we actually think it's normal. In most countries I work in, one of the things when we have initial roundtable to talk about the state of regulation in the country, I always ask the question, what percentage of the laws on the books in your country actually achieve the results that were promised? And in most countries, the failure rate is calculated to be around 80%. I don't know what it is in the U.S., but if we did assessment of all of the laws in the U.S. Code, I think we would be unsatisfied at the number of laws that actually delivered the results that were expected at the costs that were anticipated. So regulatory failure is rampant. These have horrific effects. We talk about the economy here today mostly, but I think we can't stop there. Many people around the world face horrific risks. Every time they eat a piece of meat, every time they drink water from a river, the environmental risks and consumer risks that people face around the world are horrific. Millions die unnecessarily because of regulatory failure. So when I talk about regulatory reform, it's not an economic issue only. It's really a much broader issue here, which, in my judgment, is really part of good governance. The other issue, of course, we see around the world is corruption, rampant corruption. The rule of law is threatened all over the world by corruption that's just pervasive, resting mostly on regulatory systems. I want to show you a slide here. This is a slide from Greece. This was the Greek Prime Minister about a couple of years ago when they began a program of deregulation. And I want you to just have a look at this. When I first heard the Prime Minister say this in Greece, it filled me with sadness, because this magnificent edifice that we have, the rule of law, the regulatory system designed to protect people, had been turned into a system of abuse in which the weak were preyed on by the strong. Now, regulatory systems that fail generally, systematically, lead to this. That's what it looks like. And these kinds of failures are very common around the world. So when we talk about regulatory reform, again, we're not just talking about saving a few dollars in the United States. We're talking about fighting for the spirit of good government, the rule of law, much more fundamental issues than most people understand. Now, the other point I want to make just at the beginning is that regulatory reform is an issue without ideology. In fact, if you look around the world today, more left-wing countries or governments have adopted regulatory reform programs than right-wing governments. One reason is that most right-wing governments today in the world are actually not liberal economic wings, they're corporatist. Regulation is a way of protecting special interests for them. You can look at Berlusconi in Italy as a good example of that. But actually, regulatory reform is an agenda without an ideology. It should not have an ideology. We should not be Republicans or Democrats talking about how good or bad regulation is, because the consequences of regulatory reform are good for everybody. They save lives and they save money. And this important point I really think should inform us going forward. We have to build a common coalition in the center, which recognizes both the right and left concerns about regulation and how we can address them. So the story of regulatory reform today is not an ideological story about the triumph of the market or the triumph of the right. It's a story really about the universal aspirations, whether you're a peasant in Vietnam or a lawyer in McLean, for economic prosperity, for a better way of life, for a good government that's fair, that's predictable, that's open, that's responsive to your needs. These universal aspirations are what's driving regulatory reform. And often I conclude that today, unlike 10 years ago or 100 years ago, giving men and women opportunity to improve their lives is less dangerous to governments than denying them that opportunity. And regulatory reform is about giving people opportunity. So let me come to the reform strategies for the United States. Now, we live in the golden age of regulation. The regulatory state is in full flower around the world. You know the United States figures. We've seen the numbers, the number of rules, the number of pages, and so forth. Let me tell you from other countries what's going on. Russia is seeing a 300% increase in the number of laws year on year. 3 times as many laws each year than the year before. One ministry in Egypt has adopted over 1 million decrees since 1952, since King Farouk was overthrown, which if you actually count it out, it's 1 decree every 26 minutes around the clock for 60 years. Now each one was signed by the minister. So I mean, these ministers are apparently signing machines. Now, my third example is from Armenia. Armenia is a little country of 3 million people. They've adopted 25,000 new regulations since 1991. Half the country is engaged in writing new regulations, it seems. Every country in the world, whatever indicator you look at, shows increases in the number of rules, the volume of rules, the complexity of rules, the cost of rules, and the reach of rules. And it's going up at an increasing rate. So the regulatory state really has reached its maturity. And we're at this point in history in which we're trying to create some kind of standards of quality, whatever those are. The sad truth around the world is that governments have lost control of regulation. By that I mean regulatory systems have become so decentralized, so fragmented, so captured by special interests, and so resistant to change that most governments have almost no capacity to impose any quality standard, whether it's transparency or cost-benefit analysis or efficiency or respect for market principles or even respect for the Constitution of that country. One of the issues we had in Vietnam was that many of the regulations on the books actually were contrary to the Constitution, and there was no process for correcting that. Basically, the regulators were rewriting the Constitution every day without any accountability. Now, how do you deal with that when you talk about regulatory reform? You know, even in the U.S., the job of imposing quality standards on the regulatory structure at the U.S. federal level has been a huge effort and far from complete, as we've heard today. And the United States government has invested more and has had more history than almost anyone else. In most countries, governments don't know what is regulated, how much regulation exists, who regulates, how they regulate, why they regulate, or what happens after they regulate. None of that is known. So when we talk about quality standards and regulatory reform, we have to start with a very sober reality that governments actually don't control regulation anymore. If they ever did, they don't now. Now, this has profound implications for what we do. First of all, we have to recognize that we as reformers of the regulatory state are completely outmatched by the regulatory state. We have a fraction of the resources and staying power of the regulators themselves. Out of the thousands of regulatory reform programs and efforts around the world over the past 20 or 30 years, only a very few have succeeded in reducing on net regulatory costs or interventions. And I'm going to talk in a few minutes about one example, because the amount of effort and investment needed to actually roll back the regulatory state even marginally is huge. And in Washington, of course, there's been no attempt to do that at all. So we have to be careful what we say when we talk about the purpose of regulatory reform. Rolling back the regulatory state, regulatory relief, as Ronald Reagan put it, it's not really realistic anymore. What we can do is we can achieve enormous efficiencies, and we can improve the performance of regulation, and there's enormous scope for that. And I think we should do that, and that's called the Smarter Regulation Agenda. Now, we have seen some real improvements around the world, despite all of this. This is a graph from the OECD, and what they did is they showed how the design of regulations was changing. So even as the number increased, even as the volume increased, the design was changing. This is very interesting because we're moving from more market-friendly designs on the left, more unfriendly designs on the left, to more market-friendly designs on the right. And we can see that the regulatory designs that replace the market with government decisions, like barriers to entry or controls on prices or legal monopolies and so forth, actually are becoming much, much rarer across OECD countries. What a huge triumph that is, because it has produced enormous economic gains for our countries. I don't know what Europe would look like today if this had not happened. Under the single market program, Europe would be in much tougher condition state today without the single market program that drove most of this. So thank goodness for us that the 70s and 80s were characterized by really a change in design, a change of regulatory interventions, even as the volume was increasing. So the volume isn't the whole story. Now, this is a huge success, and we should continue with this, and I believe we should expand this kind of thing to the state levels in the United States, which I'll talk about soon. Now, one of the great messages of this is that governments don't need to give up sovereignty to the market. We don't need to talk about the surrender of the state to the market when we talk about regulatory reform. We can talk about different designs. We don't need monopolies anymore. We can deal with intelligent construction of markets. We don't need price controls anymore. We can deal with more, we introduce more competition to drive down prices instead. So we're using market forces more intelligently to achieve public policy ends, and that is a very positive and bipartisan goal. Now, another thing that we've seen, a big success, is RIA, Regulatory Impact Assessment, as it's called here, or Regulatory Impact Analysis, as the Europeans mostly say. Around 60 countries in the world today use RIA. The United States was the first one to introduce what we would recognize as a modern RIA system, which has evolved quite a lot, and now a lot of non-OECD countries. My estimation is around 70% of the world's GDP today is generated under regulatory regimes that are influenced every year one or two more countries. At the OECD, we concluded that RIA was actually at the center of a regulatory reform program, as it has been here in Washington. And we recommended that RIA be adopted by every country, every member of the OECD, which now it has been, and increasingly outside. And the reason is that we saw RIA as a transformational tool that changed the incentives inside the government. By opening up and democratizing the regulatory process, it changed the incentives of regulators to behave differently. And so that's why we recommended it all over the world. Now, Jerry, was it Ellis? Ellig, who mentioned earlier the importance of the problem definition. Where is Jerry?
Right in front of you.
Yes, sorry. Who mentioned the importance of the problem definition. In our view, a good problem definition actually answers most of the questions you need to answer in the RIA. The analysis answers the rest of them. But if governments would just define the problem correctly, they would avoid many of the mistakes that they're making. And we've seen this happen in Vietnam, where we spend 80% of the RIA just on the problem definition. And it's enormously helpful for them in understanding when they need to regulate. So the RIA is extraordinarily helpful. Now, we're running into huge problems, though, with the implementation of RIA. We've seen some of them today. I'll show you an example. I really appreciate, was it Keith Hill who raised the jobs question?
Keith Hall.
Keith Hall, I'm sorry, my writing is so terrible. Keith Hall who raised this. This is a slide from a recent impact assessment done by the European Commission. And this impact assessment was on a regulation which required technical inspections of motor vehicles, of cars. So safety inspections. And they were going from once a year for older cars to once every 2 years for newer cars, and they were setting up a new regime. And look what they reported in the final impact assessment: additional jobs. Okay, so the most expensive options produce the most jobs. 46,000 jobs. So I saw that and I said to them, hey, let's require one inspection a week for every car in Europe, and we'll wipe out unemployment. And obviously this is a huge conceptual error because it ignores the opportunity costs of these resources. As someone said earlier, you can't create net new jobs by increasing costs of production or increasing costs on people, and this is an example of that kind of error. And we see this error over and over. And so we're now fighting around the world, not for the adoption of RIA, we've won that fight, but for the quality of RIA. The conceptual approach of RIA, which we're going to have to fight for a long time. Okay. At the same time, our position and the OECD's position is that no country can embark on a serious program of regulatory reform without having RIA at some point, at some level. It's really an essential technology. Now, I want to spend a few minutes talking about 4 ways that the U.S. can learn from other countries in 4 areas. I think it's time to innovate in the United States. The U.S. regulatory reform in 2012 actually is not that much different from the regulatory reform approach we had in 1985. We're depending on the Administrative Procedure Act. We are using executive orders which promote various kinds of RIA and so forth. And I'm enormously respectful about these. I mean, I do think that RIA and consultation are extremely important tools. But if I could summarize 30 years of history about regulatory reform in Washington, I would characterize it as this: RIA, more RIA, and yet more RIA. And I think RIA has some limits about what it can achieve. I really think it's time for Washington to think on a much, much bigger and more aggressive way about regulatory reform, particularly at this time in our history when microeconomic response, when microeconomic stimulation is really so important to the road ahead. So there are many other tools that are of value to us, and I want to stress that none of these are models for the United States because regulatory reform is highly contextual. But there are lessons that we can learn. I want to start with looking backward. Now, looking backward is really important because countries, all of us today, we've inherited the work of regulators over decades that have built up all of these pages that we see. And this is true of every country. Most countries have tens of thousands or hundreds of thousands of laws and regulations on the books today. And these go back a long, long time, usually over a century. The country of Italy just guillotined every law adopted before 1972, which means that they simply, without even reviewing them, they simply rendered them null. Over 100,000 laws were cut off the books in Italy with one decision, and no one ever noticed. Actually, nothing changed in Italy. They were completely unnecessary. These are the kinds of drastic actions that countries are trying to take. Now, I often say that countries have beautiful museums full of beautiful art and beautiful pieces of paintings and sculptures, but they don't need a regulatory museum. So they need to clean up the regulatory museum. And countries are like hoarders. Someone mentioned this, that they just hoard regulations over decades and decades. So we need to get the hoarders out. Over time, as the economy changes, as technology changes, the regulatory system becomes less and less adapted to the needs of today, and the economic drag becomes larger and larger. By the way, none of the economic analyses that have been done by the SBA or OMB or whatever have accounted for this. The gap, the efficiency gap between what the economy needs and what the regulations really say. Even small regulations can impose large gaps. There was a case from the United Kingdom that we looked at. They were cleaning up licensing regulations going back, around 300 years. And there was a licensing regulation on the books in the UK which forbade the selling of game meat, which was wild game meat, pheasants and deer and so forth, except in 2 months out of the year, December and January. The only 2 months you could sell game meat. Does anybody know why? Refrigeration. Before refrigerators were invented, those are the only 2 months that you could safely bring game meat from the forest to London without spoiling. So it was a safety measure. That regulation was adopted in 1720. It was still on the books in 1988 when they reviewed it. Now, what was the result of that? All of the other countries of Europe or in the immediate area had adopted ranching for game meat. In fact, family farms that were going out of business in France or Spain or the Netherlands were actually ranching game meat. So there was domesticated deer, for example, because there's a huge market for it in the restaurants of Europe. None of this developed in the UK. An entire industry was prevented by one 150-year-old regulation that had never actually been examined. They eliminated hundreds of licenses like this. So this is one example of the enormous drag on an economy of these outdated rules. Now, President Obama here called for a government-wide review of existing rules. OMB reported that agencies identified hundreds of possible reforms with savings in the hundreds of millions of dollars. Cass Sunstein wrote an article and reported that the total cost savings from this exercise was $2 billion. Frankly, I'm not impressed. It's such a trivial part of the total regulatory burden that it's hard to imagine that a government-wide effort to identify outdated or unneeded rules produced only $2 billion in savings. To give you a comparison, the federal paperwork burden in the United States itself imposes costs of $176 billion. So this was of barely 2% of even the paperwork aspects of the regulations on the books. Now, the lesson that we've learned is that self-evaluation by regulators of their own regulations has never worked in any country at any time. There is not a single case where it has worked out of hundreds of times it has been tried. And yet, this is what Clinton ordered, this is what Bush ordered, and this is what Obama ordered. So why don't we learn? Why don't we learn? It doesn't work, it hasn't worked, and it won't work. Is it just window dressing? Is it cosmetic? There's lots of ways that countries have actually tried to organize this cleaning up the stock, and there's several of them here. I want to mention one in particular, South Korea. In 1997, the Asian financial crisis hit, and South Korea lost, in 3 months, lost 16% of GDP. Now let me tell you, losing 16% of GDP in 3 months focuses the mind. And the Korean government was terrified. They decided to implement what we call the regulatory guillotine approach. They asked all of the ministries to put together a list of every regulation affecting business, every law and subordinate regulation. They asked them to come, there were 11,000 of them. They asked them to come before a national commission on regulatory reform to justify the continuation of every one of them. Many of these were televised. The president of the country would often call ministers in the evening and say, I saw you on TV justifying a stupid law. Don't justify these stupid laws. Those that weren't considered justified by the National Commission were eliminated. In 11 months, they eliminated 49% of the regulations on the books in South Korea. And the OECD work on that showed that there was a boost to GDP over 10 years of a little over 4%, which was a very important boost for a country that was in terminal free fall. Now, other governments around the world have implemented this reform, and all of them have achieved much more than $2 billion in cost savings relative to the size of their economy. All right, so one issue that we need to look at in the United States is a much more aggressive program of regulatory evaluation and cleanup, which is not based on self-evaluation by regulators of their own rules. And South Korea offers a good approach. Let's talk about federalism. Businesses don't care where rules come from. We talk about the federal government, which produced 3,800 regulations last year, but last year state governments produced 40,000 new laws in the United States in 1 year, 10 times as much. Now, businesses and citizens don't care where the rule came from. In fact, the state governments, in my view, are behaving with a program of deception, because every time a citizen complains about a state rule, they blame the federal government for it. I've seen this many, many times. So there's a huge lack of accountability in the United States about who actually is responsible for what's going on. Now, my feeling is that when we consider microeconomic recovery in the United States, state regulations are becoming just as or more important than federal regulations, because here is where the real barriers to entry are emerging. The states have put into place thousands of licensing requirements, for example. Many, many conditions on entry into professions. We've heard some of them, I think it was at Matt? Matt Mitchell? Yep. Did I write that correct?
That one.
who gave us some great examples, like hair braiding. And there was a recent case in Atlanta exactly on hair braiding, where a mother with children was trying to make extra money by braiding hair in her apartment, and she was closed down by the state regulators as a threat to health and safety of a great state of Georgia. So I think it's obvious that Washington doesn't have the power or the authority under the Constitution to command the states to regulate better. So, we don't have a Treaty of Rome, for example, the single market program that Europe has in many of these areas. But I'd like to look at what Australia did, because Australia faced a greater problem than we did. I don't know if any of you have followed Australia. It's a fascinating economic case and reform case. But back in the 1980s, the Australians were rapidly falling relative to other countries. They went from number 6 in the OECD in terms of GDP per capita to number 26 in about 10 years. And there were books written in Sydney in the late 1980s which predicted that in a few years, Australian college graduates would be serving tables in Kuala Lumpur. They would become the waiters of Asia because Australia wasn't producing the jobs anymore, wasn't competing with the rest of the world, and they were declining rapidly. So there was a lot of fear in Australia. What did they do? Well, they created a national program of competition, which was based on a systematic review of regulatory restrictions on competition in every state and every ministry at the federal level. So how did this work? They created, first of all, a common approach, a national approach, which every state agreed on, which was called the National Competition Policy for Australia. In the National Competition Policy for Australia, they agreed to review all laws and regulations against principles of competition, particularly market entry and other principles. They agreed to those principles, and they also agreed to an enforcement mechanism. They created a National Competition Board, and they had a productivity commission, which basically was the utility regulators who did the oversaw the RIA work to be sure that it was done honestly. Now, the guiding principle for the whole country was that regulation should not restrict competition unless the benefits of the restriction to the country outweighed the costs, clear benefit cost grounds, and the objectives could only be achieved by restricting competition. So there was a cost effectiveness grounds there. This took about 9 years for the whole country to complete. They reviewed tens of thousands and eliminated or simplified or revised tens of thousands of rules from one end of the country to the other. Now, one of the interesting things about this, there were 3 monthly reports by every state to the national group. It was called the Council of Australian Governments, in which every government was represented as an equal partner. The Council of Australian Governments reviewed progress across the country, and there was also a system of payments. So the idea was, as you increase competition, you increased economic activity. As you increase economic activity, you increase tax revenues for the country. And so the federal government paid over 6 billion Australian dollars to the states based on performance. The more you performed, the more money you got from the federal government for this work. So there were incentive payments to perform. Now, when this was finished, the analysis showed that it increased real GDP in the country by about 5.5%. Sounds pretty good, doesn't it? And that's 5.5% on a long-run basis, or $23 billion a year, every year. And that increased annual household income by about $1,500. No tax increases, simply economic efficiency. They continued this, by the way, with the National Reform Agenda, which also involves a system of payments. If the national government and the state governments agree that reforms will increase economic activity, then there are payments to the states who carry out those reforms. Why can't the U.S. do something like that? Is it beyond us? I don't think it's beyond us. These are the kinds of things other countries are doing that are much more ambitious than the United States is even considering. Interinstitutional arrangements. The United States government is famously fragmented, and it does good things for us. Balance of power, check and balance, and so forth. But it isn't good for regulatory reform. Why do we spend so much time improving the quality of subordinate regulations and so little time improving the quality of laws? It's widely known that laws are actually the lowest quality regulatory instruments in our country because they come out of a process of almost no quality control at all. When I tell other countries that the RIA process applies only subordinate regulations but not to laws, they're astounded. Because in every other country in the world, the RIA is applied to draft laws. Why not us? Well, you know better than I do why not us. But let me give you an example of where it works better. In Europe, there are 3 main policy bodies. The European Council, which is the ministers from all the European states, the European Commission, which is the executive branch, and the European Parliament. All of them are very jealous of each other. Working together is really not something they enjoy doing. The Treaty of Rome gives each of them prerogatives, and they guard their prerogatives like dogs on a bone. Yet, when they adopted the Lisbon Agenda for growth and jobs in Europe, they realized that it's not up to one of them to safeguard regulatory quality. It was up to all of them. And if they didn't work together, it wouldn't get done. So they created the Interinstitutional Agreement on Better Lawmaking, which is signed between the European Parliament, the European Commission, and the European Council. And part of this is an agreement on impact assessment. So there's an agreement on the content of the RIAs, there's an agreement on the process of the RIAs, and there's an agreement on what to do as policies are changed at various parts of the policy process. So when the European Parliament changes a draft directive or regulation, the RIA is adjusted to show the consequences of that change. So they don't behave in an uninformed fashion or hasty fashion. They don't wait until the midnight hour at the end of a session in order to pass a 200 or 2,000-page law. They use RIA as part of a more rational, more transparent process of policy making. Now, they also agree that they will use the impact assessments prepared by the Commission as the starting point. So there's not competing impact assessments being done by various institutions with different conclusions. Each one builds on the impact assessment of the other. Yeah. The lesson here, divided and competitive government institutions don't help regulatory quality. Why can't we do something like that? Cumulative effects. And I want to show you this. Some of you have seen this before. This is a famous slide prepared by the American Forest and Paper Association. Are you represented here today? This is an industry which is under a regulatory attack. What they did is they looked at all of the regulations in just the EPA pipeline and that were affecting their industry, and this is their map. And when you looked at the prospective costs of all of these regulations, the costs are 3 times the annual profit of the whole industry. Now, EPA doesn't intend to wipe out the paper and pulp industry in the United States. Nobody actually decided that was good for America. There's 3 million jobs at stake here. And yet the uncoordinated and cumulative impact will have that effect. So what do we do about this? Well, RIA doesn't answer the question. Now, one of the problems that we've all known about for RIA for a long time, but we don't talk about very loudly, is RIA, in the way that it's done here in the United States and everywhere, is a marginal analysis of one rule. And in fact, when we do the baseline for the RIA, we actually separate out the effects of all the other policies so that we can isolate the effect of only this rule. This sounds good, right? That way we know what this rule is doing. But we're missing information that's very important to us. Now, logically, the questions asked in RIA, does a solution produce benefits that justify the costs? And what solution produces the highest net benefit? They're sufficient if you're going to make a marginal decision on that rule. Those are the right questions. But I don't think they're right for a national program. And for example, these questions, which only focus on marginal impacts, is why we've done such a poor job in the United States of reducing the burdens on small businesses. Even though we know those are the real issues of concern to politicians. If you look at the recent political campaign, nobody said, we want to be sure that every rule passes a benefit cost test. They say, we want to reduce burdens on small business in America. And yet RIA doesn't get us there. It doesn't help us. Now, how do we think about the cost of regulation and how do we manage it? Now, I do believe that the principles that the U.S. has adopted now are not correct for this, because what the U.S. executive orders say is that if a regulation passes a benefit cost test, it should be adopted. What that really says is the U.S. should adopt every regulation for which the benefits exceed the costs. Now, just imagine if we applied the same principle in budgeting. Let's suppose that we have a federal budget in which for everything that we can spend money on in the United States where the benefits exceed the cost for that program, we put in the budget. What do you think would happen to the federal budget? Benefits are unlimited. It would explode. Right? It would take up the entire GDP of the country very quickly. The central problem here is that benefits are unlimited, but costs are limited. Costs are inherently constrained by the wealth of our country. Now, what do you do when you have benefits which are unlimited but costs which are severely limited, and you're only using a benefit cost test on marginal reforms? You can't control the overall level of costs. Now, I also think there's an even bigger problem here. I think that the opportunity cost of regulation increases as the cumulative burden increases. So the trade-off between benefits and costs is different for regulation number 100 than it is for regulation number 1. There's nothing in our system that accounts for this. There is no limit on the regulatory costs that our system accounts for or is able to account for. Now, this is true around the world. No other country has been able to set a limit on costs or determine what is the appropriate level of cost for the country, what is the right level of cost that we should spend through regulation. We don't have any policies. Now, one of the things that the UK has done that I think we should consider, and I do want to give a lot of credit here to John Morrell, who back in the 80s was pushing the idea of the regulatory budget, which was theoretically a wonderful idea, never broadly implemented in any country. One of the things that the UK has done lately is the one in, one out. One in, one out means we don't know the current cost of regulation, but whatever it is, that's the one we're going to accept. So today's level is the level that's appropriate for the UK. And every time you put a new regulation into place, you have to take out an old regulation of the same or higher cost. Okay. So you can't put in place a new regulation unless you find an old regulation to replace it with. Now, the UK has announced last year that this has been a success. They announced that we have stabilized the cost of business of new regulations. So they believe that as a result of this, the cost of regulation in 2012 is the same as 2011. They don't know what it is. They don't know if it's too high or too low, but they've stabilized it. Okay, that's a step forward. They've also actually created a market for regulatory reductions because you can bank regulatory cost savings against future regulations, and you can even get regulatory cost savings from other ministries. So if I'm OSHA, and I say to EPA, I have a big regulation, and I say to EPA, why don't you deregulate in that area, and then I'll take your cost savings, and I'll have my, that's perfectly acceptable to the UK. So they can bank it, they can trade staff to each other, they can trade interns, whatever currency the ministries want to use. But the issue is the entire budget, the regulatory budget. So will the one in, one out model work for the United States? I don't know. But these are issues which are not being seriously discussed, and we should look at other countries to see what's going on. 2 points to finish. One is, as I mentioned, the regulatory state is in full flower. Regulatory reform is just budding. So if you look at the introduction of fiscal management, it took 80 years for the modern budget to develop. From the end of the 1800s up to the middle 1900s, it was about 80 years for us to have what we call a modern budget. We've begun that process now for regulation. In 60 years, it will be inconceivable for a country to have laws and regulations without a regulatory management system in place that involves RIA, that involves consultation, that involves other tools. So we're at the beginning of a long-term process of change to the regulatory state. So we should not despair. We should push on. And finally, I want to conclude with a remark from Douglas North, which is changing beliefs is the fundamental force for change. So if we don't change people's beliefs about the role of the state in the market and how regulation defines that interface, we'll never win this. So we've got to work at the level of businesses, people, citizens. We have to have an outreach and communication program in order to win this long-term game. Thank you.
That brings us to an end. I'm sorry we don't have time for questions, but I was going to sum up, but I think Scott has done an excellent job of summing it up. It is time to start our regulatory reform efforts. It can't be by one administration. It has to transcend administration. So thank you all so much for coming.